Because for the most part, a lot of that work is already done for you, right? They pay
Okay.
other people millions and millions of dollars to make sure that their company is doing well and that it can go up in value. The fact that it's a Fortune 500 company is the reason why you should be buying it in the first place, right? So,
Hmm.
what I look for is I want to make sure that money is flowing into the company. If money is
Right.
flowing into the company's going to go up. If the money is
Right.
flowing out of the company's going to go down. So I don't necessarily have to, the homework is already done. Google has already done the homework for me.
Okay.
Now, in the past, before we had the technical and fundamental things that we use to look up stocks, we had to go that route to kind of fundamentally look at what a company is and how much that company can actually grow. But in the last, I would say maybe, I would even say since 2008, since the real estate market crashed, the whole market, any book that was written before 2008 or 9, I consider obsolete because the way things work now is totally different and we look at the market a totally different way. So my job is to that stuff is great. You can read as many books as you possibly can. I don't really recommend any books because again, everything is obsolete in my opinion. So I have a different approach to the market. So I always tell people you should be looking at the market in three ways: short term, medium term, long term.
Right.
And as long as you're looking at it in three ways, I feel like, and I'm going to make a lot of sports references because I was an athlete, but you want to be the LeBron or the Michael Jordan of the market, and in order to have a well balanced view of the market, you have to have offense, defense, and you have to have the ability to actually teach somebody else. So and understanding the principles of why things go up and down. And as long as you have the fundamental principles in place, you will be able to trade any and everything. All right, and that's usually my goal. I don't tell people that there shouldn't be anything that they should buy. Right? You should be able to buy anything as long as the market cap, in my opinion, is $1 billion or higher. But once you find that particular company or asset class that you're investing in, you want to know if it's bullish or bearish, and you want to always put yourself in the best position where you have the highest percentage of winning. All right.
Right.
So
Right.
I'm gonna break it all down to you because I started out in the beginning. I got I didn't have anybody that can teach me, so I'm self-taught. So I had to go out there and literally learn everything. And I learned all the studies that are out there. I have a biology degree, so I have a scientific mind. So I studied everything, and I thought that I needed all of these different things to make money in the market. And I went to having information overload where I wasn't making money, and then I pretty much broke it down and simplified it and said, you know what, stocks are either going to go up or down. The billionaires are going to buy the best companies. Like as long as I know that, trading and investing is going to be a lot easier. The other thing that I noticed that a lot of traders and investors didn't do is they didn't break down the time frame in which they were buying. All right, and that's where a lot of people go wrong. They're looking at charts that represent different time frames. So if you break it down in the beginning, then you're like, oh, okay, I can see Apple. I can make money on Apple long term, and I could be shorting Apple, betting on it going down in my short term account. I could be doing the same thing, going in opposite directions, and still be making money both ways.
Right.
And when you start looking at the market in that way, you start to become a well balanced trader investor. So let's go ahead and get started. So I'm gonna go ahead and share my screen.
Okay. And I did go to the stock party about 5 or 7 times.
That's great. So a lot of the stuff that
Okay.
we're going over should be it should be just a review. Okay.
Right.
Before we actually get into the advanced technical side. And believe me, I'm only going to give you the fundamentals, the basics of the basics, trends, support and resistance, a
Right.
lot of the things that you mentioned beforehand. All right. So can you see my screen?
I can.
All right. Cool. Cool. All right. So this is advanced technicals. Again, you already took stock party, but we're going to cover a couple of the things that we went over in that stock party. So again, just in case you didn't know it, I'm a full-time day trader. That's how I earn my income. I don't do any other business. I'm an expert in stocks, options, futures, and cryptocurrency. Over 10 years of experience. I'm self-taught and have over 10,000 hours of trading experience. So that's what you get with me as a coach. I also don't really like, and this is just my opinion, I don't really like taking advice from people that I call old heads, which are people that made money in the market and now they're teaching and they don't understand how the market works today because it's different. All right, so I tend to listen, but really not listen. I listen for the things that I want to listen for, but I really like having my soldiers who are out there in the trenches around me. So I really rely on my trading room a lot more than I see the people that are on TV. Okay. Because a lot of people that are not in the market, they don't understand. They're disconnected to what's going on at this particular time. As a trader, you got to have your pulse on what's happening in the market. And people that are not trading are just not going to know. All right. There are fundamental and cyclical periods where certain stocks do well, like at Christmas time, everybody knows that that's called the Christmas rally. So tech stocks tend to go up in price from November, December to January. So every single year I'm buying Apple, Amazon, Google if I'm day trading, and I tend to make a lot of money towards the end of the year. Oil companies tend to, when the economy was open, oil companies usually do their best during the summertime because that's the traveling period. Anytime people are traveling, you're going to see oil probably at its highest price. But of course, we're in a pandemic right now, so we're not going to get the same reaction that we should get from oil. Also, you got to understand what a lot of people come into the market and they just try to trade things because they think they believe that prices are low and they want to buy low and sell high. You have to be able to look outside and understand what's going on around you to be able to be a good trader, not an investor. All right. In the stock party, I always separate trading versus investing. Trading is when you buy something and you sell it within a 12-month period. Investing is when you buy something and you plan to hold it longer than a year. You know when you're trading versus investing, because if I'm investing and something goes down in price, I should be excited so I can buy more of it. That's how you know it's an investment. If you buy something and then it immediately goes down in value and your stomach hurts, well, then you are probably trading. Okay. So you gotta be able to separate the difference between your trades and your investments. And it's the biggest issue that my clients have. They don't know which route to go. That's why you should be doing all three. If you're doing all three, then you're not going to have any question on what's happening or when to buy more of that particular asset class. All right. We all want our assets to start going up in price immediately. But as an investor, if I don't have all the money that I need to put into that particular company, why do I want it to go higher? I don't have enough money in it yet. I actually want it to go lower. Okay. Because I have a 5 or 10 year period where I know that I'm going to be in that company, but I only might have 1,000 in it right now, and I need to put 10,000 in it. All right, so I'm waiting for it to drop in value, and there are going to be times that you know when to buy it. So we're going to separate all of that stuff so that we can make sure that we know for different time frames how to handle ourselves in the market. So fundamentals is always what to buy. This is what you learn. You know, I want to buy fundamentally good companies. I don't ever read. I don't have enough time to be able to read the reports or listen in on, what I will do is I watch publications every day. If you want to know how I operate in the market, I don't go a day without watching Fast Money from 5 to 6 o'clock every day and Mad Money from 6 o'clock to 7 o'clock. I spend 2 hours a day listening to A, what the billionaires are buying, B, they break down everything on TV the way that you need it to be broken down. They do all the homework for you. And then what I do is I'll take the information that I find from that 5 o'clock and 6 o'clock show, and then I'll do my own little personal research on it. But most of the time, you're going to hear what the hot stocks are, what the billionaires are buying. I don't listen to what people, I do listen to what people are trading in my trading room, but I also want to hear what the billionaires are buying. I get that from those two different shows. I've been watching those two shows probably for the past 7 years. I have not missed an episode, even when I'm on vacation. All right. So I'll tape it. I'll put it on my DVR. If I'm working out, I'll watch it while I'm working out. If I'm cooking, I'll watch it while I'm cooking. All right. If I'm cleaning or doing whatever, if I'm in my car, I'm going to be listening to it. It's only 2 hours a day that I do my homework. Okay. Now, but remember, I'm a full-time day trader, so I have to know what the end thing is so that I can make money on it. Like everybody knows today, the biggest stock, the biggest company that moved the most today that everybody was talking about, that's the most popular, was Harley Davidson. So HOG was up 28 or 30% today. I also know that everybody was buying Snowflake today. I also know that Bitcoin was up very big today. All right. So those are three different things. If I was a day trader, those are the things that I wanted to trade for the day. Because when billionaires are buying things, I want you to think about this. When billionaires are buying things, they are so much bigger than we are. We tend to get in things too fast and get out of things too early. All right. When billionaires are buying things, it takes them hours, sometimes days, sometimes weeks to buy something. All right. So when you see a stock that's up big for the day, it's probably going to continue to go up for the day. All right. Or at least for the next hour. So as a day trader, I want to capitalize on that. Okay. I also know that if it's up big that day or the next 2 days, it's probably going to come down again before it starts to go up again. All right. Rookies usually buy off of news. They will hear that HOG is up today, and then they'll just say, oh, I got $10,000, let me go buy HOG today. And then when it goes down in price, they sell it because they're like, how come I just lost 10%? Okay. That's what rookies usually do. All right. So we're gonna talk about trading versus investing, but I'm throwing a lot of concepts out there for you so that you can start digesting it. But for now, let's talk about the fundamentals again. Fundamentals is what to buy. All right. So if we were on Yahoo Finance and we were looking up Apple, the very first thing we want to look for is what the price is. And the price really doesn't mean anything anymore to me. And that's what I teach my traders and investors. Price means nothing. What matters is how big the company is, because this is where you make your money, not here. You do make money on this going up in price, but if I looked at Apple today and I saw that it was $363, I wouldn't know how big that company is. I wouldn't know if it was a small cap or mid cap or a large cap company. I would have no idea. The only way you're going to be able to get that information is through the market cap. I don't know if this company is bullish or bearish. How do I figure out if it's bullish or bearish? Has money been flowing in this company for the last year or 5 years? Because if hedge funds are pouring money into a company, chances are it's going to continue to go up in price. Okay, they don't get in and out of things like we do. Okay. I actually call the big money the dumb money. The way that they look at the market and the way that they invest in the market is so simple that sometimes we outsmart ourselves. So if money has been flowing into Apple for a year to 5 years, chances are money's going to continue to flow into these particular companies, because once you become part of the end class, you got to understand how money works in America. A lot of these mutual funds, a lot of these hedge funds and pension funds that are handling all of our money, what we usually do is we'll go to work, they'll take money from our checks, they'll put it in our 401ks, and there's some company that's managing that money. Well, the people that are managing that money, they don't go out there and say, hey, I'm going to look for some speculative stock to put this money into. Nah, they're going to look at the top 30 companies, and they're going to say, all right, I'm going to put 1% in Apple, 1% in Microsoft, 1% in Google, and they're just going to go down the list through the top 30. So those companies are going to get money no matter what. All right? And when you understand that, you start to say, oh, okay, if they're going to get money and money's flowing into it, it's a fundamentally good company that's going to get money regularly from these hedge funds. All right. But I need to know how big that company is going to grow. Well, if Apple is a $1.5 trillion company, now it's a $2 trillion company, how much money can I make? Well, if I look at the last 5 years quickly, and I see that it rose from $150 to $300, well, there's your number right there. If Apple rose from 150 to 300 in 5 years, that's 100% return. Over a 5-year period, that's an average of 20% a year. Okay. Can you stomach making 20% a year? How did I get that information that fast? All I did was look at what the market cap was and what it did in the last 5 years. And that told me, about what my average appreciation is going to be in that particular stock. So people that are buying Apple right now, expecting it to go to $1,000 or $3,000 a share because of 5G, it's because they don't know how much that company can grow. All right. I also need to know if it's realistic for this company to double or triple in the last year. How do I get that information? By going to the 52-week range. What did Apple do in the last year? Well, Apple, the lowest price was $192 and the highest price was $372. So even if I caught Apple at the lowest price and sold it at the highest price, I would have made 100% return on Apple. So anybody expecting to make like 500 or 600% return is being unrealistic. Literally just by looking at this, I don't have to read any books. I don't have to read up on the company. All I need to know is money flowing in? And if money is flowing in, what's the average? 20%. How long will it take for me to maybe double my money? Maybe 3 to 5 years. Why? Because that's what it's done in the past. Is it a fundamentally good company? Of course it is. Because if I look at a 5-year chart, I see that it went from the left side of my screen up to the right side of my screen. Money's been flowing in. Okay? Fundamentally good company. All right? So you're going to have a worksheet that I give you. This is the worksheet. You should already be able to fill this information out, except for the last thing. You should be able to write down the stock, the ticker symbol of the stock, the market cap. Apple is AAPL. Its market cap is $2 trillion. It's a bullish company because its money's been flowing into it. Its 1-year high, you should be able to get from the 52-week high. You should be able to get the low. You should see if it offers a dividend. A dividend is what a company pays you to own that particular company. And then you need to know what type of beta that company has. We're going to talk about the 200-day moving average later. But why do I need to know what beta is? Because beta, anything over 1.0, is considered a volatile company. All right? It's going to appreciate more than your average portfolio. Anything under 1.0 is really, really conservative. All right? When you multiply it times 10, it's going to give you an average about how much it can be up or down a year. If I multiply 1.17 times 10, I'm going to get 11%. Oh, I can expect to at least get an 11% return off of Apple every single year, depending on the volatility of the market. That's under regular, normal conditions. Okay? All right. Any questions so far?
Basically, you just said that if you look at beta, and you multiply it by 10, you can guesstimate how much of a percent the stock will rise more or less in a year.
Yes.
Or fall also, how much it will fall more or less in a year.
Yes.
Okay.
So think about it. I know personally when I look at Apple, because of the beta of the market, so the volatility of the market is like double. So double whatever you see the beta is. I don't even have to look at Apple to know when to buy it. All I have to do is say, all right, what is the 52-week high? 372. I'll take 20% off. That's when I'll buy Apple. I got that number just by multiplying this times 10, which was 11.7, and I multiplied it times 2 and got 20%. So I know that Apple's going to fluctuate about 20% from its highs to its lows. So I know how much money I can make when it starts running. And I might say, ooh, I might need to start getting out of this company. Or when it drops, I can say, ooh, it's on sale. But is it going to be on sale 3%? Nah, it can drop even more. How do you know that, Joel? Because it has a high beta. Can it drop 10%? Ooh, I think it can drop more because the volatility of the market is higher. I'm going to wait for that sweet spot, which is 15 to 20%. That's when you're going to start seeing me come in the room and say, all right, guys, it's time to buy Apple. Okay? Never had to understand, I already knew that it was a fundamentally good company. But this is how the hedge funds think too. They're adding to their positions every single month. So they might say, all right, Apple is down 20%. We're going to increase our exposure into Apple. So we're going to add, instead of 2%, we might buy 4% of our portfolio into Apple because we know that it might not be the actual low, but at least it's 20% off from the highs. And if we expect this company to be higher or to continue to grow because it's been averaging about 11% for the past 5 years.
So how are you getting 11% from this 1.17 beta? How do you get that one?
All right, so the S&P 500 is what everything is based off of.
Right.
So if I pulled up, let me stop sharing my screen. All right, can you see my screen?
I can.
All right, so if I was to plug in SPY, no matter how many times I put SPY into should have hold on, where's the beta? It's not here. Oh, the SPY's beta is usually here it is. All right, no matter how many times I plug in the SPY, the beta is always going to be 1.0. It's always going to be 1.0. Always. Okay. Never changes. We know by looking back at history that the average, the market averages about 9 to 10% in appreciation a year. Okay? So most people double their money every 7 to 10 years. The S&P 500, that's 1.0, everything is based off of the S&P. So it's not so because we're not including the VIX, which we're going to talk about later. We have to assume that it's so Apple in comparison to the S&P 500. Let's say Apple was 1.5 to make it easier. Okay. Let's say the S&P 500 is up 10% of the year. Well, if Apple has a 1.5 beta, it's going to be up 10% plus another half. It's going to be up 15%. It's going to be up compared to whatever the S&P is. Let's say the S&P 500 is up 20% for the year. A company that has a 1.5 beta will be up 30% because they're going to be up to 20%. The S&P is, and the half, which is another 10, and it's going to make them up 30%. Okay? So under normal conditions, when the S&P 500 is up 10%, Apple's going to be up 11% because 1.0 times 10 is 10%. Okay. 1.17 times 10 is 11.7%. Okay? Uh-huh. That makes sense?
Okay. Yes.
Okay. So, let's go back.
I'm actually going to get onto the computer that I have that has the capacity to do sink or swim. So, and then I'm going to log off this one. So I'm just you'll see somebody entering the room, but it's me.
Okay, so let me make sure I let the security down so you can join. So you understand this and you understand dividend, correct? I need to go over.
dividend, and that's the dividend is what the reward you're paid on a quarterly basis, and the
Yes.
yield is the yearly amount.
Well, yeah, it's the percent that you're still paid quarterly.
Okay.
Yep. So you can either look at the yield or you can look at the yield, or you can look at the amount that they pay you, because they're either going to pay you, because you can easily look at it and say, if they offer a $3.22 dividend for every share you have, then you're like, oh, okay, for every share I have, I'm going to make $3.22 every year.
Right.
Or if you only own, like, let's say you're doing fractional shares and you don't own a share and you only own 3%, but that amount that you have is $1,000. Then you can look at the yield and say, oh, okay, out of that $1,000, if they paid 1%, then I'm going to make $10 every single year. I'm going to get paid $2. I'm going to get paid $2.50 every 3 months.
Okay.
So when I'm fundamentally looking up my company, I look up this sheet. I pull up this sheet and I fill out all that information. I write down the stock, how big the company is. If it's bullish, I'm only buying it if it's bullish. I want to look at the highs, and I want to look at the lows. I gotta find out what the high is, so that I know if it pulls back, whatever the beta is, I know when to buy it. Okay.
Right.
And then the last thing is going to be your discount price, which now I want you to find what the 200-day moving average is. And we're going to look up that in a second when we start getting into the technicals. All right, so the technicals is when to buy.
Right.
Okay. So if you haven't, again, you said you've already done the stock party, which is fine. And you said you've watched it 4 or 5 times, but these are other videos that I'm gonna give you access to this futures party. Okay. I'm gonna give you access to this technical strategies party.
Okay.
And I'm also gonna give you access to this options party. Now the futures party, I'm gonna teach you options tomorrow, but because futures is gonna take 2 hours, you're gonna have to watch the video to learn the futures part. Okay. All right. And have you already set up your charts on Thinkorswim?
No. That is a big. That's a big opportunity. Okay.
All right, cool. So yeah, you're definitely gonna have to download this video. Okay. And it's gonna you're gonna be able to set up your charts. Now I'm gonna go through my charts today, so you're gonna be able to see some stuff, but you're not gonna be able to get the full thing until you download this. You're gonna have access to this video as well. So I'm giving you all of this stuff for free.
Okay. Wow, thank you. I really appreciate that. I really mean, golly. Can you tell me what the meeting ID is? Do you know that? Because I'm trying to log into this other site. Let's see, and I'm having a little bit of challenge. It says find your local number. Let's see. Let me back in. Join our crowd. Oh, here it is. I see. I can join it now. Okay. You've chosen Zoom package. Open with installer block. Okay. Download a few seconds. Let's close that one out. Okay. Launch meeting. Okay. And then open the link. Zoom link to okay. Says it's connecting. Okay, good. Now I'm gonna get off of this. So there you go. Alrighty, so let's say goodbye.
Or you can mute one if you want to.
Okay.
Yeah, like if you just wanted to keep the picture and the sound on one, and then look at it on the other one, just make sure you mute one of them. Sounds like your computer's still looking up, still trying to connect to audio.
Okay, there you go.
Oh, there it is. Yep, it's on now.
Okay.
All right, I hear that echo.
Yeah, I tried to mute it. It didn't work, so I'm just hanging up on this one.
Well, I can mute it from my side if you just tell me which one to mute.
The one that says. There we go.
Okay.
Well, let me get here. There you go. That was it.
All right.
Okay.
Cool. All right. So, first things first. For success, you need to separate your accounts. All right. I have a short-term account, a medium-term account, and a long-term account.
Right.
So, what just happened? Let me go back.
You said get M1.
Not necessarily. I like it. I like M1 because of the pie that you can create.
I got one.
Okay. Oh, you created a pie as well?
And I funded it already. I got 3 stocks. So.
All right. Cool. Just make sure that you keep funding it every single month or 2 weeks or 3 weeks or whatever your schedule is, or 6 months. Just make sure you do it systematically. Don't worry about profit and loss in the beginning. To be honest, don't even really look at that account. All right? Just because that account is for high growth companies. All right? And if you're looking for high growth companies, you want to know what I'm buying. I'm buying companies like Wingstop, cryptocurrencies, cannabis stocks, electric car companies, semiconductor companies that can grow, companies that are dealing with web services like a Salesforce or a Twilio. I'm looking for companies that have very high growth potential, companies that can grow from $5 or $10 billion in market cap to $100 billion. Okay. My longer term accounts, I have the Apples, the Microsofts, and the Googles. Okay. Those companies are only going to give me 10 or 20% a year. They're still growing, so they're going to make you money. They're not gonna double or triple or quadruple like a Square or a PayPal. Right. Okay. So those are the companies that you want to start building with smaller amounts of money, and then before you know it, it's gonna be just as big as your larger accounts. Okay.
Okay. Because I have an annuity with TIAA Crest, and I switched to their growth stocks.
Growth stocks.
And it's 30, because the one I was at was at 2% growth per year. I switched it to 37% growth per year.
Yes.
So thank you. I have been trying to do this since 2016 or 2017, and I had 1 share of Apple stock, and after taking your class, I made so many moves. I saw a financial planner. I got this fractional shares account. I switched my annuity to something that was, stronger, the long term, stronger. So I said, I'm seeing myself implement. So this is a wise decision to move forward.
Most definitely. You just got to be prepared that when you're in those high growth funds, you automatically know when things are bad. Things are bad. But the stock market always pops back faster than any other industry. You got to understand that. You're going to be uncomfortable for 3 to 6 months. That's it. After 3 to 6 months, you're going to see it grow back. I mean, we even during the pandemic, we were the market fell for about 30 to 45 days, and then within 60 to 90 days, we were already back, right? And a lot of people missed out on the move, and that was and now that you're going to be able to look at the volatility index, which I'm going to show you in a second, you're going to know when to put your foot really on the gas. Okay. All right. So just make sure that you are separating. Hold on. Your accounts. Why is this not working? Oh, there we go. So how am I positioned to win? Fidelity is my long term. M1 Finance is my medium. Thinkorswim is my short term. Thinkorswim will allow you to have multiple accounts. You can have 5, 6, 7 accounts with Thinkorswim, and you can toggle in between them while you have your platform up, which is why I love it. Okay? 10% of your assets, out of all the assets that you have, 90% needs to be in longer term stuff, 1 year to 10-year holds. This is your boring account, your 10% a year. Even though you have it in a high growth fund, that's still your boring account. Okay? this should always be more aggressive than this, and this should always be more aggressive than that. Okay? So you want to be aggressive and conservative at the same time. Okay? That's how you're going to win. Okay? But we got to learn how to do this. That's why we're only going to keep 10% of our assets here, because this is where we lose the most. Right. Because we're the most emotional, and that's the one that we're going to be getting in and out of. So we got to protect ourselves by only having 10% of it as trades. I only use a $30,000 account to day trade. Now, my $30,000 account gives me access to 120K, but it's still 10% or less than my overall assets. Okay? So just because you have it does not mean that you need to trade it. A lot of people are like, no, Joel, I'm go hard or go home. I'm like, you can do that. Just let's do it with 10% of your account. All right. So we're going to learn candlesticks, going long and short, support and resistance, trend lines, and identifying trends today. Okay. Our next session, which is going to be another 3 hours, that's when we're going to learn the options and the option strategies. Okay. In between that session, it's up to you. You can take futures in between by watching the video that I give you, or you can watch it after we do the options. Okay. That's where you're going to learn how to make $100 a day. Okay. But you're gonna apply the same techniques and the same advanced technical stuff that we're looking at today. Okay. All right. So of course, I always tell people, empty your mind. Anything that you've learned before, I want you to put it over here. I don't want you to completely delete it from your brain, but I want you to approach the market totally different now. I want you to approach the market by understanding the flow of the market. Because a lot of people come into the market and they're taught to go against everything that they see. They gotta be the black sheep. And I'm like, you don't want to be that way in the market. You want to go where the money is. You want to look at the ocean and say, if the ocean and the waves are going left, I need to swim with the ocean. Okay? I don't want to go against something that's bigger than I am. And when we come into the market, our egos and our big brains make us think that we can outsmart the market. And it's not about outsmarting the market. It's knowing what the market is doing and then applying however much money we need to make sure that we continue to make those funds. We want to buy fundamentally good companies that are going up in value. All right. We know how much they're going to come down. That's how you outsmart the market, by buying companies that are good. And when those waves go up and go down, we now know about how much is going to go down just by looking at the beta, just by looking at things like the 200-day moving average, the support and resistance areas. But the 200-day moving average and the beta and the VIX is what I use mostly to kind of figure out the best price to buy something when I'm looking at it long term. All right, so the trend is your friend until it ends. I have to literally change 90% of the people that come in contact with me, because this was just not a concept that they believed in. And that's why a lot of traders struggle, because when things are trending to the upside, they don't ever come back to the price that it started from. And I keep telling people that you don't want to buy companies that are going up and coming back to the same price and going up and coming back to the same price. That's a sideways trend. That company is confused. You want companies that are going up and they're just stair-stepping up in value. Those are trending companies, okay? Yes, you want to buy low and sell high, but I don't want you to buy low here. I want you to buy low because it dropped, 50% of this move. I want you to start.
I'm sorry to interrupt. I don't see your screen though. I don't
know. Oh, you don't?
No, sorry I see you. I see you, but I don't see the right.
Let's try it again.
Okay. Yeah.
Now you can see it?
Yes, I can.
All right, cool.
I don't see myself, but I guess I'm not supposed to. That's fine.
I see you.
Okay, good. All right. Yep. Perfect.
Yep.
Perfect.
So that was the agenda. That was Bruce Lee.
Okay. Like water.
And this is the trend is your friend.
Yes.
All right, so we don't want to buy here, and a lot of people do that. They say, I want to buy low, sell high, Joel. I see it rose from 10 to 100, so I'm gonna wait till it gets to 10. That's not a trending stock. Stocks that trend don't come back here. And when they do come back here, that means they're about to go lower. And that's why a lot of traders struggle, because they don't understand that they need to get in or out, or they're trying to get in something at a lower price, and they don't know if they're trading or investing. So we're going to break down all the different time periods. So first things first, candlestick charts. Candlestick charts are the most used charts in the stock market. Everything works off of candlestick charts. Futures market, options market, foreign exchange currency, which I don't even teach, cryptocurrency, I don't care what it is, the most common chart you're going to see are candlesticks. And the reason for that is because candlesticks are going to teach you, what's going on in that particular candle. We're only going to talk about 3 time frames. All right, 1 minute chart, 1 hour chart, 1 day chart.
Okay.
Short term, medium term, long term. Okay. 1 minute is short term, 1 hour is medium, 1 day is long. Those are the only 3 charts I'm going to teach you. Every single chart, there's going to be a different strategy that you have to approach the market. Okay. All right. In those candles, so when we create your charts on the Thinkorswim platform, we're going to create in that video, I show you how to create a 1 minute chart, a 1 hour chart, and a 1 day chart, and what to put on those particular charts.
Right.
But within those candlesticks, every candlestick is going to tell a story. When you're using the Thinkorswim platform or any other platform, you're going to see green or red candles. Green represent up in price, red is down in price. The body's going to always represent the opening and the closing price during that time frame, whether it's a 1 minute candle, a 1 hour candle, or a 1 day candle. It still represents during that time frame the opening price and the closing price. If it's green, it went higher. If it's red, it opened early that morning or early that minute, and at the end of that minute, it closed at a lower price. The wick just tells you how high and how low it went during that time frame. Okay, body's gonna always represent opening and close. High and lows is just how high and low it went during that 1 minute, that 1 hour, or that 1 day. When you're looking at a stock chart, you never have to worry about mixed charts. It's either every single candle's either gonna represent a day, an hour, or a minute. Okay.
Right.
This is the best book. Now, this is one of the only books that I recommend. If you have to look at a book, if you had to buy a book, this is one of the first books that I bought to learn price action. It's Japanese Candlestick Charting Techniques by Steve Nissen. It's going to show you 6 different patterns of the market. We're going to learn a couple of those patterns today. When I'm teaching my What Would Joel Do method, I use a bullish pennant type pattern. And then I make it my method by adding what I call the John Carter, and I'm going to add the Ichimoku. We're going to talk about that later.
Okay.
So, let me pull up my charts. All right, can you still see my screen?
I can.
All right, so today, for example, we were using a 30-day. I was looking at GBTC. Now, why was I looking at GBTC? GBTC is Bitcoin in stock form. So people that can't trade Bitcoin or have a cryptocurrency account, they'll buy GBTC. So earlier that day, at 9:30 this morning, I told everybody, oh, these are the stock stars of the morning. Bitcoin was on that list. So if you wanted to trade it, day trade it, you would have come to your charts. You would have made sure that you had a 1 minute chart, because when you're day trading, you use a 1 minute chart. Okay. Now, I know people that use all types of charts. Using the What Would Joel Do method, you're going to use a 1 minute chart because Joel simplifies everything. If I'm trading intraday and I'm getting in and out the same day, I'm going to use a 1 minute chart. If I hold anything overnight, I'm going to use an hour chart. If I'm going to hold anything longer than 30 days, I'm going to use a day chart. So intraday, in and out the same day, 1 minute. If I know that I'm going to hold this overnight, there's no reason for me to look at a 1 minute chart. I need to look at an hour chart. And that's from 1 day to 30 days. Anything more than 30 days, I'm going to use a day chart. So when I woke up this morning as a day trader, you're never going to know. The best day traders that I've seen are the day traders that have no idea what they're going to trade that day until that day. Anybody that commits the night before, they're not day trading. They've already committed to something. They don't even know what the weather is. They laid out their clothes. They woke up that morning with their shorts and their shirt and walked outside and did not check the weather. And the weather said that it was going to be raining today. Okay? So many traders do that. And I get it. They put in so much preparation. They're like, all right, this is it. I'm going to make my money today. I've been looking at Apple all night long, and I've been looking at the fundamentals of it, and I hear that they're coming out with all of these phones, and they've already trained their brain in going long that morning. So then they wake up that morning, and the market is down big. But what are they doing? They're buying Apple to the upside for a day trade. That's why they lose money. A great day trader has no idea what they're going to trade. I woke up this morning and said, whoa, market, what are we going to trade today? What are the billionaires buying? Because the billionaires ain't going to tell you the night before what they buy. So I woke up this morning. I saw Bitcoin was up. GBTC was up. And I saw a whole bunch of e-commerce companies up. Amazon, Shopify, and I saw Microsoft and Mercado Libre. All of them were up. That told me that's what the billionaires are buying. I didn't have to go and look at any other stock. And this screener is I created this watch list, but I created this watch list, and by 9:15, 9:20, I already knew what was probably going to be up in price in the next hour. So I pulled out my 1 minute chart. And what did I do? We're going to talk about this in a second. When looking at a chart, this is what we call a gap in price.
Right.
That's what you're looking for on a bullish stock. You want it to go up, you want it to come down, then you want it to start going right back up. That's the move that you're going to get most of the time in a very bullish company that companies are going to be buying all day. Because think about it. If a billionaire hedge fund decided we're going to buy GBTC today, we're going to buy 1 million shares today. Do you really think they're going to wait for it to come down to here? Nah. They're going to look for the first time it dips, then they're going to start buying, because anything lower than this is on sale for them.
Gotcha.
And because they're putting so much money into the company, they can't push a button like us and get in and out. It takes them an hour or 2 hours to buy. So you're going to see the first dip. When you see that first dip, as soon as it starts to go up in value, and that's the what would Joe do method, you get in. And you know where my stop's going to be? Right there. A stop is a price that if it reverses,
right,
that's where I get out.
Stop.
So when I lose, I only lose this amount of money. But when I win, look at how much I win. So if you bought GBTC this morning and you were day trading, let me pull up my calculator, and you want to see how I make money, I usually use about 20 grand. And I say, all right, I'm going to get in with $20,000 right around, let's just say the $15 level, just to make it simple. Of course, I would have got a better price because I'm a super trader. All right. So it went from $15 all the way up to $15.60. All right. Now, first of all, when we got in, it would have been right around 10 o'clock. I only trade for about an hour, maybe even 2 hours. So it rose from $15 to $15.50.
Wow.
So I would have been up $665. And I would have made that within an hour or two. How did I know to trade that? Because first of all, I didn't even know what I was going to trade. B, I wanted to find a company that popped in price. C, I don't buy it just because it's up. Bitcoin is open at $9.30 at $15. Everybody buy it. Nah, we're going to wait for it to drop first. Because all bullish companies go up, then they go down, then they go up, then they go down, then they keep stair-stepping up. So just wait for that move. Soon as it drops, and what I want you to do is, when the company hit its high, anything underneath that should have been on sale. Why do I want to buy something at the highest price? No, not me. If it's at $15, I know I could probably get it for $15. But we never know what the lowest price is going to be. Now I'm going to show you something. It's called a trend line. I'm going to show you how to draw those. All I did was wait. We're going to erase this one. All you would have done was waited for the trend to go down, and as soon as the trend started to go back up, you buy anywhere between here. So you could have bought it for $14.93 all the way up to $15.05. Your stop's going to be right there. Your stop is always at the bottom of the second move. So this is move number 1, move number 2, move number 3. You get in. Now, I'm going to do this over and over again so that you can get it, because it's not going to be an exact trend line for everybody. Some people would have drawn a trend line right here. Some people would have said, all right, it went up, then it went down, then it started to go up. All right, I'm in. That's fine. You still would have got in at $15. You see what I'm saying? And some people would have got in there, and then they would have immediately had to get out right there for a loss. Okay? But then it started to go back up again, and they would have retried that trade. When I lose, I only lose a little bit. Okay? And I want you to understand that. There's nothing wrong with losing. It's just repositioning yourself on a move that's probably going to go higher. Okay? And at some point, we were up at, at some point, we went all the way to 15.7. Right?
Wow.
We just dropped lower. But the reason why I wanted to show you this was because it's a 1-minute chart. Now, this is where people go wrong. They look at the most common chart. Now, I'm going to show you something. The 1-minute chart showed us something totally different than what a day chart is going to show. If I had a day chart on here, you're going to see something totally different. You're going to see this.
Oh.
You're going to see this, and you're going to see all of this that happened. And you're going to be like, I'm not about to buy this for a day trade. I'm going to wait for it to drop down here or right here. It's too high. People tell us not to ever buy at the all-time highs. Yeah, but not when you're day trading.
Okay.
When you day trading, yes, you do. But you see how even when you're day trading and we were at the highs, we waited for it to sell off, but it looked nothing like this chart. This chart looks totally different. Hold on, let me put all right. So this morning you would have seen it at $15, and you would have said, I'm not buying this. But if you were buying it for a 5-year period, you would have said to yourself, oh, maybe if I was buying this over 5 years, I would notice that, look, the highs was $38.71. So $15, and I'm going to hold it for 5 years. Now it looks like, does it really matter if you buy it for $15 or $14 if it's going to go to 38? So depending on the chart you're looking at, it can tell a totally different story depending on your strategy. Now, let's say I wanted to buy this for a 3 or 4 day move. Then I'm going to use an hour chart. And when I use an hour chart, I'm going to get something else that's a little bit different. If I was going to buy this for a couple of days, it's still a little bit too high for me. Okay? I want it to come down maybe to this middle range here before it starts to go higher again. I want it to go up, down, and then up again. Just like it did here. See, if I was waiting for this, I would have waited for it to go up, down, then I would have started to buy it right around here. Okay? And I would have immediately made money the next morning. That's how you trade something day to day. But I don't want to use a 1 minute chart because a 1 minute chart is not going to show me what a 1 hour chart is going to show me, which is what a 1 day chart is going to show me. Now, every single one of these candles represent an hour. So if I look down here, this is Wednesday. No, this is Tuesday. This is the 9:30 candle. The 9 to 10 candle. This is the 10 to 11. This is the 11:30 candle, 12:30, 1:30, 2:30. Okay? They're going to represent an hour. But I'm not going to buy it until it comes down and then it starts to go back up. Why did I buy it? We're going to talk about that later because of this Ichimoku. This Ichimoku, just by being above it, you would have known that this stock was probably going to continue to go up in price. Okay? Because the Ichimoku is a trending indicator, but I don't want to get ahead of ourselves. All right. Any questions before we go back to the presentation?
No.
All right, cool. So you understand candlesticks.
Yeah.
And you understand how to read them. All right. On your platform, if you want to read your candlesticks, there's going to be information right here. You're going to see DOHLCR&Y. You see that? So if I was to put my cursor on any of these candles, it's going to give me the information. So if I chose that candle right there, if I look up top, it's going to tell me that it's the October the 9th candle at 9:30. It's also going to tell me the opening price of that candle, $12.16. It's going to tell me the high of that candle, which is H, $12.30. It's going to tell me the low of that candle, $11.96. It's going to tell me the closing price of that candle. So it opened at 9:30. It probably closed at 10:30. It closed at $11.99. The range tells me how big the candle is. The candle is 34 cents long.
Okay.
And the Y just tells me where I'm at right now. You see that? No matter where I go to, that Y is going to change. Okay? So you can find that information right there just by highlighting any of these candles or this crosshair. Whatever the crosshair touches is going to give you the information for that particular candle. Okay? All right. So let's go back to the presentation. All right, so now let's talk about advanced fundamentals before we get to the advanced technicals. All right, so do you understand going long and short?
Going long is estimating that the price will go up. And going short means you're basically in a put situation, or if you were in options, you would be betting that the price would be going down.
Yes, and if you're buying short, you can buy. You don't have to necessarily bet on the market going down in options. You can short a stock and bet on it going down. So you can short stocks, or you can buy put on stocks, betting on them going down.
Okay.
Now, the way that it looks like this. If I wanted to buy 10 shares of Apple, let's say you and I both looked up and we saw that Apple was at $300 a share. And you said, I'm going to bet on Apple going down in price. And I say, well, I'm going to bet on Apple going up in price. Where I'm going to go to my platform. I'm going to hit buy plus 10. The plus tells you that you're going long. So I'm going to buy plus 10 shares of Apple at $300 a share. It's still going to cost me $3,000. You're going to say, I'm betting on the market going down. So you're going to place an order, but you're going to put a minus in front of it. And that lets me know that you're betting on the market going down.
Okay.
You still need $3,000 because you're buying 300 shares to go short. So, but 300 times 10 is still 3,000.
Right.
If Apple goes to $200 a share, you make $100 a share times 10. You're going to be up $1,000 if Apple drops to $200 a share. I'm going to be down $1,000 $1,000. You're going to make what I lose. If I make money, I'm going to take it from you. Okay. So this is literally the opposite of what this is doing, and this is the opposite of what this is doing.
Right.
So if I look into your account right now and you have minus 77 shares of Apple, I'm like, oh man, you're short 77 shares of Apple. Now I get this question all the time: can you be long and short at the same time? Yes and no. All right. You can own shares of Apple and have puts on Apple at the same time. Okay. But you can't have 10 shares of Apple and short 10 shares of Apple.
Right. Because that cancels.
It's going to cancel each other out. So if you want to be both at the same time, one has to be stock, one has to be options.
Okay. So going long, that means you're buying, anticipating the share price is going to rise, and going short means you're buying, anticipating that the share price will fall. Okay, great.
Yes.
I knew one meant, I knew one meant going up and one meant going down, but I really didn't understand all the finer points of that.
Yep. So long is going up, and that's being bullish. Right. Short is betting on it going down. That's bearish. And if you were buying options, buying a call is betting on it going up. Buying a put is betting on it going down. But but when you're talking with somebody that understands the market, you got to make sure you separate going short from buying puts, because that's literally buying options or buying stock. Or actually not even buying stock. You can go short in the futures market. Or you can go short in the foreign exchange currency market.
Oh, wow. Okay.
Which means you're betting on things going down.
Okay. And when they go down, then you will make the difference
from where you started.
Right. Okay. From where you started. Okay.
So if something's $100 a share and you decide to short it, and then the next day, let's say it's $25 a share, you're going to be up $75.
Okay.
Because you were betting on it going down. Now, the way that you get out of a short is you do the opposite. So if I bought 10 shares of Apple, to get out of it, I would sell minus 10 shares of Apple. Plus 10 minus 10 equals 0. If I'm shorting 10 shares of Apple, I got to buy plus 10 shares of Apple to cancel that out.
Okay.
Okay? Minus 10 plus 10. Minus 15 plus 15. Plus 15 minus 15. Plus 10 minus 10. Okay? All right, cool. All right, so if you want to see how that order looks, it looks like this. Let's say I wanted to, I don't even know if I could short this stock, but if I wanted to short, oh, hold on, let me take my, I think I had my auto send on earlier. I need to take that off. Auto send just basically, there no box pops up. You just literally get into that trade. Advanced stuff. Let's say I wanted to buy, let's say I wanted to short GBTC. Well, I would hit the sell button to short. I want to short it. I want to short, let's just say I wanted to short 100 shares at whatever price we're at right now. So we're going to go to edit. And if I look up, I see that we're at 1569. So if it says, if I put short at 1392, it's going to give me this price, because the higher the price, the better.
Wow.
Okay. So I hit this little key and it tells me I can short one share at $15.68. So I will go to confirm, and it will say that. I'm sorry, that says 100. You just can't see it. If I wanted to short 100 shares of GBTC at $15.68, it's going to cost me $1,574 minus my commissions, which is $695, which I don't know why I'm getting charged a commission. I should have no commissions because I'm a pattern day trader. Oh well. Maybe Thinkorswim. Oh, that's interesting. Maybe Thinkorswim on shorts they charge you for it, but on longs they don't charge you the commissions. I gotta check into that. All right, so if I was shorting it, it would cost me $6.95 plus the $15.68. Okay.
Mm-hmm.
So I would start shorting it. If it dropped from $15.68 to $15.58, I would make 10 cents times 100, right? I would make what, $1, right?
Mm-hmm.
10 times 10. No, I would make $10. All right. So if I was in this short and it dropped in price, to get out of it, I would buy back 100 shares on that particular short. So this is how it would look, and I would hit send. Okay.
Okay.
All right. Oh, let's go through that again. There's different orders that you can take. So let's say I wanted to buy GBTC. And let's say I wanted to buy it, but I didn't want to buy it for $15.60. I wanted to buy it for $15.30. Or let's do $13.64 because that's really low. Okay. Well, I can go in here. Let me pull this over so you can see the whole order story. All right. So if I wanted to buy, let's just make it 1 just in case I make a mistake. Let's say I wanted to buy. Let's say I wanted to wait for this to drop down to this price. Well, I would do what's called a limit order. And I would change it here. And I would say, all right, I want to buy this when it drops to $14. And I could put whatever cents I want. A limit order means that price or better. Once I place this order will not take unless GBTC drops to $14. If I place this order, and let's say I just left because emergency happened. I left and I came back and I was like, oh my God, I forgot to place my order. If GBTC never gets to $13 or $14 within that day, then at 4 o'clock, this order is going to delete. It's going to cancel. Right. That's what limit is and for the day. Now, if I wanted this order to place, and let's say I was looking to buy it at $14 and I decide I want to go on vacation. And I said, I don't have time to look at this every day. I just want to buy it at $14. I don't care when it is. It could be in the next 7 days. Then you can place what we call a GTC order. That's good till cancel.
Right, till cancel, right.
So I can buy this, and no matter what happens, it can be the next year. It could be 2 years from now. It will not buy GBTC unless it drops to $14 a share. If I wanted to get in this immediately, I would go. I do market, and market is going to give you whatever the market order is at that time. Right. You don't have to worry about buying at market and getting it for $18 a share. All right, especially when you're using the Thinkorswim platform. Now, I do tell people this: don't place market orders when the market is not open, because stocks can gap down or gap up, and you can really get smoked out there. And don't buy market orders for options. You are going to get the worst price. So don't do it. Always use limit orders when you're using options. Okay? And that's gonna put you in the best position. All right? All right, so let's go back.
Do you mind if I chime in for the areas that I'm certain about?
Yeah.
Okay.
It's your session, so you can.
I'm starting to, if I just sit here, I'm starting to get sleepy.
All right, cool.
And I've actually studied so much, but I just didn't like the idea of losing. I felt so uncertain, and I was like, I don't want to, be like a calf that just got born 30 minutes ago trying to walk. I'd rather invest some money, Somebody that knows what they're doing, so I can feel a little bit more confident.
I get you. All right, so we talked about beta. Remember, beta. When you look up the beta of a company, you're going to see 1.0, 2.0, or 3.0. All you do is you multiply it times 10. So that company is either moving 10, 20, or 30%. Okay? I don't really see betas higher than 3.0. Most of the time, like Square has a 2.7 beta. That means when things are going up, that's the type of company you want to be in. That's the kind of company you want to trade. The higher the beta, the more money that you can make. Volatility index. Why is this important? All right, so we talked about temperature earlier. Temperature is what are the conditions of the market. The volatility index is going to pretty much tell you when the bottoms of markets occur. So if you ever wanted to look up that particular index that's going to tell you the absolute bottom, you have just found it. This is what the 1%ers use to know when to dive deep into the market. Okay? There's only 3 numbers you should look for because you don't usually see anything higher than 50 every year. Okay? It usually takes about 10 years, 5 years before you see the volatility rise higher than 50. So 16, 32, and 48 are the numbers that you look for. I want you to think of the volatility index like the ocean. Let's say you're a surfer. And surfers love waves. Now, the waves can't be too big like a hurricane or a typhoon. Otherwise, they would drown and get killed. Right. But they still want to see big waves. They don't want to see no waves. 16 is no waves. 32 is perfect conditions. 48, the waves are too big. Okay? So when you're looking at the volatility index, and you should only look at it maybe once a day, once a week maybe, figure out what the conditions of the market are. When the conditions of the market are around 32, those are the waves that traders like. You're going to get enough volatility in the market, you can make some money, especially in the options market. When the volatility gets above 50, I don't even want you to trade anymore. I actually want you to start investing.
Okay.
Because when the market is above 50, that means we're panicking. Something is happening where there is a tornado or a hurricane or a typhoon occurring, and the market is trying to digest this negative information. Now, what I want you to know about these periods is that when this happens, it's usually short-lived, right? So usually when we get above 50, it doesn't last. Like when a tornado comes, it doesn't come and you don't see a tornado for a whole year or for a whole month. You see a tornado come in, it destroys everything, and then everybody tries to rebuild after that. So traders use 50 as an area to go all in on stock. In the last 10 years, this is the volatility index, which we call the fear index. This is what just recently happened. What recently happened was a volatility that spiked all the way to 80. We haven't seen a volatility of 80 since 2008. Oh, wow. So that's why traders knew to go all in. Because A, we haven't experienced that type of fear. And B, when we experienced this type of fear, it only lasted 120 days. So just by looking at the volatility index, you would have known, we know it's a pandemic, but the economy might get messed up, but that's not going to stop big businesses from running. It's just not going to. The poor are going to get poorer, the richer are going to get richer, because the rich are going to start pouring into great companies that are fundamentally good. If you look at the last 20 years, this is the last 20 years. What do you notice? This red mark represents 50. Look at what every time we hit 50, look at what happened. Every time we hit 50. Now, this lasted 120 days, but most of the time when we hit 50, it only lasts 30 days. Every time we hit 50, we go back to all-time highs. 16 represents all-time highs. 50 represents the lows. We hit 50, we go back to the highs. 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 Okay, we hit 80. We went back to the highs. Okay? So you gotta.
So this is where if I see something like this or like this, then I can do an option for
Yes.
200 days because I know
Yes.
it's gonna. Oh man.
There you have it. I bet
Wow.
you woke up then.
This is that was worth the price of admission. I mean.
Exactly.
Oh wow. And
Exactly.
so this is for the entire market.
Yes.
Okay.
This is the entire market. It's the volatility of the market. Okay. And it's called market volatility.
Yeah,
you can find it. You can find it by either typing the VIX, or you can go on Yahoo Finance and type VIX or type CBOE VIX, and that's the one that everyone looks at. 3 numbers: 16, 32, 48. Anything higher than 48 is just ludicrous. I mean, once you get afraid, you're just super afraid. I mean, once you're afraid, you're afraid. So that's when everybody knows we're near the bottom. But
because rookies are selling. I mean, people, the retail investors are selling they're ready to jump off buildings.
Yes, because retail investors can't separate the economy from the stock market. They think it's the same, and it's not. The stock market represents the rich and billionaire businesses. They're going to continue to run. The economy's not going to make people are not going to stop going to McDonald's or stop using Amazon. Now, the smaller companies are going to get beat up. So what usually happens when something like this happens is, you got to find out what conditions are we in. See, this was a different fear than this. When the real estate market fear happened, then you had to stay away from banks and other things like that. The pandemic was a different type of fear. So because we were at home, we still had to buy things. Right. We were quarantined. So all e-commerce companies did extremely well. Okay?
But airlines and hotels and cruise ships.
Right. They're going to do well 5 to 10 years from now. But think about it. If you were sitting on $1 billion, are you going to take a shot at an airline or a shot at Amazon?
Amazon every day. Yeah.
Amazon all day long. And that's thinking like a trader. Okay? An investor can say, yeah, maybe you can make more 5 to 10 years down the line off of an airline company, but I need to make some money now, and I want to make some money later. So now that you have your 3 brains, you're like, okay, I'm going to buy these airlines and put it in my long-term account, but I'm going to trade the heck out of this Amazon right now. And I'm going to make enough money here where I can take those profits and invest it in something that I can sit in for 4 to 5 years. Okay?
Wow. So now is a good time to invest in, with travel, but for the long term.
Yeah, most definitely. But don't expect it to go up right now. Expect it to go down for the next 2 years.
Wow. Excuse me. Wow. Jeez.
So, and that's how I approach the market. I look at different industries and I say, ooh, I need to have about $10,000 worth of Delta, but I don't have it now, but I can go make it right now in these options in Amazon. Mm-hmm. See what I'm saying? It's a different way of thinking. I got to get the money. Where do I get it from? From whatever is running right now. Okay? And then
so
that's where
the stock market is not the business, is not the economy.
No.
But rookies think that. Okay, good.
Yeah.
Very good.
Yeah. Joe, there's 50 million people out of jobs. Yeah, you out of jobs at home ordering from where? Amazon. Yeah, so you got to separate the two. And that's where people go wrong. Totally separate thing. Just think of the stock market is the rich and the economy is the economy. All right, the rich are going to get richer during these particular periods. All right, so let's get to the advanced technicals finally. All right, we can put all this stuff together And now let's apply a bunch of the stuff. We already did part of the advanced technicals just by looking at the 3 charts. But we gotta understand what we're looking for. So first things first, and you can see my screen, correct?
Yes.
All right. First things first, we need to talk about support and resistance. You've been using support and resistance your whole life and didn't even know it, right? Support and resistance areas are just areas where companies love to buy, or they're areas where stocks can drop, or they're areas where if the beta is 1.5%, right, and we got a VIX that's double, we know that the support area is probably 30%, right? So you got to look for those different areas on your chart. And you're going to be able to see it. It's clear as day when you see those support areas. I immediately knew this was a support area. Right. Even when this stock went up here, I knew that this was a support area. A resistance area is an area that is trying to break through.
Right.
Once you break through resistance, resistance becomes support.
Right.
Okay? So even in this particular situation, looking at this chart, you can tell that this is the support area, this is the resistance area. Traders love trading it. They'll buy at the support, sell at the resistance. Buy at the support, sell at the resistance. So you can make money on a market that's going sideways. Mm-hmm. But let's think about support and resistance in supply and demand. Let's say before COVID,
you said before COVID, you could buy, basically the price of eggs was right within that $1 to $2, but then demand increased and supply also decreased. So now we had the resistance became the support in the new time, in this challenging era or time frame. And so now the prices rose from going in between 1 and 2 to between 2 and 4, and you said that, no matter what, you were not going to be buying, paying $4 for the eggs, but, you could hope to get them, yeah.
Yep. So that's support and resistance. You got to look for those different areas when you're trading. All right. Even Apple, even when it's going side to side, when it breaks that resistance area, you got to know where it broke from. You got to understand how traders think, because it's very hard to buy something here. Because people are like, why are you buying it here? It's higher than here. Because you are trading now. You got to understand price action. And price action is, if money is flowing into it, money's going to keep flowing into it. Money just doesn't flow into something and then stop. And I think that's the problem that a lot of traders have when they're trading the market. Again, the trend is your friend until it ends. So you got to be able to be really good at using trend lines. Trend lines are subjective. No two people draw the same trend line. They never will. Okay? So when things are going down in value, I want you to treat this trend line as an area where you're underwater. If it goes down, I'm going down underwater. When I break above the water and I can take a breath, then trend can change. If I'm above the water and my head's above the water, my head is going to stay above the water until it goes underwater. When it goes underwater, that's when this trend line ends. How many candles does it take to draw a trend line? I always tell people 3. It takes 3 candles to draw a trend line. 3. Okay? All right. So this is how it looks here. I could have connected these 3, or 1, 2, 3. And then when it broke that trend and I saw a new one, draw another one. 1, 2, and 3. It's not perfect, but 1, 2, and 3. And you want to hold it. You don't know how low a stock can go. We think we know how low a stock can go. You don't know how low it can go. But I know when money flows into it and it goes up, money's probably going to continue to flow into that company. Okay? So you're looking for a V. We call that a V recovery. When you see it go down and it breaks and you see it take a breath, that trend can change. Okay? You got to be able to use trend lines in this game. If you can draw a straight line, you're going to be decent in this business.
I took a YouTube class, and they were just talking about whenever you see a lot of green candles, that's the sellers, like in a hand-to-hand combat with the bears. The bulls are winning.
Mm-hmm.
So
Exactly.
And it's basically, you know, they said tug of war. The bull, is it the bulls or the bears? And the fluctuations in the high and low tell you what's happening with the price action between bulls and bears in that particular period.
Exactly.
Whatever the candle represents.
Exactly. This is the first tool that I usually give to my traders. The very first tool you use. All right. Yeah, trend line. Ooh, sorry about that. Yeah, trend lines and support levels is something that you should be drawing, but this is your tool. Like, this is when you get knighted as a trader. And I tell people, look, if you can't use a Fibonacci tool, stop trading, because this is going to teach you price action. It's going to teach you that when stocks go up in value, they stair step up. They're going to stair step up in value. Okay? And I know I went through the stock party video and I showed you how when stocks go up and they're trending up, they don't come back 100%. They come back between 25 and 50%. So when a stock is going up, if you miss this move, wait for it to drop about half of that move. You can take a shot to the upside. So even when it goes up, I usually put a trend line here. And then if it gets to the 25 or 50% area and start to go up again, Joel gets in, I put a stop right there. Same thing here. It goes up, it goes down, it starts to go up. Joel gets in somewhere around here. Joel puts a stop right there. All right. Same thing here. This was the March lows. When Apple went up in value in the last year, it dropped 50% of that move. Soon as it started to go up in value, you buy it right around 260. That's actually the price that I bought it at, around 260. My stop would have been right here at around 210. Okay, and every single time that happened, it never reached my stop. So I was 100% for Apple. Okay, and if you were buying options on this, you could have made a lot of money. Okay, as a trader, which we'll talk about in our next session. But that's your Fibonacci tool. Now, when you're using your Fibonacci tool, if you are shorting, you're going to do the opposite. I see a lot of people do the wrong thing. This will come down. They'll draw their Fibonacci tool from the bottoms and the lows, but you got to do the opposite. You got to start here and come to the bottom so that when it pops up 50%, it can drop. So you got to start here and then put it here. I'll show you how to use it in a second. But that's how it looks. All right, so let's go to the charts really quickly. Any stock you want to look at really quickly for me to analyze?
I think it's Rio or Neo.
Neo. All right, so let's look at Neo. All right, so I'm conditioning your brain. Do you want to look at Neo as a day trade scalp, a swing trade from 1 to 30 days, or anything longer than 30 days?
You said that 1 to 30 is the best, is the most lucrative to trade?
No, it's the hardest to trade.
It's 1 to 30? Well,
yes.
Which one is the easiest?
The easiest is anything longer than 30 days.
Let's look at in longer than 30 days.
All right, cool. All right, so we're gonna look at what kind of chart? We're gonna look at a day chart. So we're gonna look at Neo on a day chart. So when I look at Neo on a day chart, first thing I want to do is I want to start drawing. And what I should do is have you pull it up on your Thinkorswim and you draw it. But I'll show you first. First things first, I want to I kind of want to paint, I want to paint a picture. So I never, it doesn't have to touch it immediately. I just want to immediately draw a trend line across here. Doesn't have to be perfect, because I can always go in there and adjust. But I just want to get an overview. So I usually go in there and then, you can go in there and adjust it like that, or you can pull this down a little bit if you want it to be perfect, if you want it to try to be as perfect as you can. So that's the first thing I do. So I already know that I have support at this trend line. So if I was looking at buying this for a couple of days, I would say to myself, I would look for gaps. 80% of gaps fill. So I'm going to come down here and I'm going to look at this gap, and I'm going to put that gap there. As you can see, I have an alert there.
Mm-hmm.
If I want to set an alert, I would right-click on my screen, and I will look for that value. Now, 80% of gaps filled, that means they're going to fill all the way back to where it started from.
Oh.
Okay? So it should come back to $21.90 at some point. Now, it doesn't have to happen in the next day or two, because as you can see, it didn't care about that gap. It made money for the next, 4, 5, 7, 8, 11 days.
Mm-hmm.
So I don't want you to just go out there and short every time you see something that has a gap.
Oh, that's what you mean. Okay, great. I heard that, but I didn't know what people meant when they said most gaps fill. It means that as time marches forward, they're going to come back and fill up.
Try to test that little area. But what I like about it is that area is in line with this trend line. So it can come back, fill this gap, and still be bullish and go higher, because it can come back, hit this line, and go up higher. So if I was thinking about buying this for 30 days or longer, there's a couple of things I'm going to look for. So if I want to buy this for 30 days or longer, Joel's not going to buy it now. Why? It's a bullish company. Yes, it is. It's a bullish company. If I was going to take a chance, it would have been today, because we broke this trend line and we started to go back up. So I know that it can at least go to $29.40. Now, why would I wait? Well, I would wait because I just think that I can get this maybe for a better price, okay? Because this trend line here is way stronger than this line, okay? Mm-hmm. This is this is for now. This is a trend line for now, day to day. This is a trend line for week to week. The longer the time frame, the stronger the support level. This is a 200-day moving average. That's 200 days. This is going to be stronger than this, which is going to be stronger than that. So I would probably, if I was to get in here, the only way I would have probably bought this for a 30-day trade was if we had more than, if we had more room to the upside. Like if we hit an all-time high and then we bounced all the way down here, and then we started to go up, I would have said, I could have made $5 to the upside. $5 in the options world is about $500 because you're controlling 100 shares. But because we're so close to the highs, I would day trade it or swing trade it maybe for 1 to 30 days. But I wouldn't take this as a longer time frame. I would just say, you know what? What's a company that's similar to it that I can make money on for now? And then I would go over here and say, all right, what are other car companies? I would go to my car industry and I would say, what are other car companies that are similar to NIO that I like that could be going up in value? I would see what companies are up the same time that NIO is up. Well, I see that this company is up. I see that Nikola is up. I see that Tesla is up. So let me look and see what Tesla is doing. So then when I look at Tesla, look at what Tesla's doing. Well, Tesla is hitting that trend line and bouncing up. And I have more room to the upside in Tesla than I do for NIO. So if I was trading for 30 days, I would skip NIO if I just had to trade a car company and then trade Tesla. So I always do that. When I'm thinking about a company that I'm looking for, I look for what we call pairs. And I would look for other companies that are similar to it. And I already have my list. So see, if I picked up BYD, the reason why people are buying this one is because Warren Buffett is invested in it. It's also already at its all-time highs. So I don't want to trade that one. I'll look at Solo. I'll look at Nikola. Nikola is underneath the 200-day, so I'm really staying away from that one. And it's John Carter is red, which is what we're going to talk about in a second. Race is Ferrari. Okay. But if I wanted to stick to electric cars, I would just stick to my electric car companies, like maybe a Workhorse, okay, which is down here. And as you can see, maybe this is a better buy for 30 days or more. What am I looking for? Well, it's falling in price. It's falling in price, so I immediately want to look for my support and resistance areas. Well, my first support area is going to be, I guess, where we're at right now, maybe even right there. It can fall to 1550. My major support area is going to be this 200-day moving average. That's where it looks like Workhorse wants to go to. Guess who already has an alert set up for it? So this is how you set up an alert. Let's say I wanted to set an alert for Workhorse. I would go to my screen. I don't ever make it exact. I just say, I don't know if this can keep going up and this can keep coming down. So maybe when it gets around this area here, $12.33, I right click on my screen and I go to create alert. When I create that alert, it's going to ask me for the price. The price is the mark. I want that mark to be at or below. If I put at or above, well, we're already above that price. So the alert's going to go off immediately. So I want that mark to be at or below. So when Workhorse, the stock, is at or below $12.33, I want to be alerted by sound, by a text message, by SMS, and by a text message through my mobile. Okay? So I'm going to get alerted in three ways. My platform's going to bling. It's going to go bling, bling, bling. And I'm going to say, what the heck was that? Then I'm going to go to my messages. And I'm going to say, what message did I get today? And it's going to tell me Workhorse is at whatever price. I'm also going to get a text message that says Workhouse is at that level. Okay. Right? I'm also going to get an email. Okay. So when I set my alerts, I want to get alerted in every other place because I don't know where I'm at the time. I want to get alerted.
Right.
That alert can be a triangle like this, or it can be a line on your screen. So you go to Style, Settings, and right over here, it's going to tell you about your alerts. You can have your alerts show as an arrow, or you can have your alerts show as a line on your screen, like this. So let's say I wanted to cancel one of these alerts. All you have to do is hit the X button. Okay. And now that alert is gone. Let's say I wanted to change this one. I can raise this to $14.
Oh, okay.
And now I just replaced it, and now that alert is $14.14. Then I can lower it back to 12. And then I can change it back to an arrow if I want. And there you have it. Okay.
Okay.
And that's your alerts. Okay. So that's how I would look at NIO. We're going to talk about this in a second, but I also want to look for the John Carter and the 200-day moving average. The 200-day moving average is the last 200 days. We talked about that in the stock party. We also talked about the John Carter. So if you wanted to buy this NIO on a day chart, you should have bought it when the color changed to green. When it changed to green and you got one candle, two candles, three candles, that's the alert that you should be buying it. One candle, two candles, three candles, you should have been buying NIO. Okay. Now let's break it down into three different. Let's say we're looking at a 30-day. We're looking at a day chart. So that means you can buy this 30 days or more, or you could be buying this for a longer time frame, which is like, long term. So when I get three candles like that, I don't just buy it immediately. I put a trend line across the top of it. And then as soon as you break above the trend line, you could have bought it that day for $24. Now, it's higher. It is higher. So be careful. But you could have bought it there, and within 2 days, even in the options world, you would have made a lot of money. Or if you want to just continue to hold it because you bought it here, you could put a stop. As soon as it started going your way, I always tell people to put a stop at the price that they bought it at. And now you won. Now you just sit in the stock. Unless you get one of them days where you wake up and it's sitting at $16, you should be able to break even on this stock.
And when you say break even, that means that if it goes south, you will only lose. You won't
what
lose.
You started. Yeah, you won't lose at all. Break even is I break even. I took the trade, even though I'm up, it came back to the price I started at, so I don't lose any money on this trade. And now,
do you set you can't set 2 stop losses on a transaction or trade, can you?
You can, but what you're doing is if one triggers and gets you out, the reason why I say that is, let's say you have 50 shares. You can set two different stops where if it drops to one level, it only sells 25, and then when it drops to the next one, you sell another 25. But if you only have 25 shares and you put a stop at 25, and then you put another stop for 25, guess what's going to happen? It's going to get you out of one, and then when price hits the other one, it's going to put you short for 25 at that second stop. And you're going to be going in the opposite direction.
And so the reason I'm asking that is, like, I understand about the stop loss, but like, what if some people just say, okay, this is going up here. It's at, let's just say it's at the $26, 28.44 level. And I bought it at the $24. So maybe I say, hey, you know what? I just want to cash out. I know it may still be rising, but I just want to get some, I don't want to show a profit on paper. I actually want that money in my pocket. So, I mean, can you talk about how instead of having a stop loss below to prevent loss, when it's on a run, is there some way that you say, well, you know what's going up high enough, or do you? That probably sounds crazy. Do you ever just say, you know what, I want to make some money, I'm just going to sell, I know it's still going? Or do you, as a day trader professional, you say, you know what, I'm not touching it until I see the evidence that's going to go down?
No, the professionals will say, look, there's nothing wrong with taking profit. So I don't think of. So first of all, I don't want you to think in absolute terms. I want you to think of terms of, let's say you're up $100 and you own 2 shares. You could sell 1 share, pocket $50, let the rest of it ride, and if it goes up, you win. If it breaks and goes back to the price you originally started at, you still profit. Because you took part of your profit then, and then you let half of it do whatever it's going to do. Gotcha. That's how I trade. Okay. I'll trade until I'm up, and then I'll take 50 to 80% of my profits, and then I'll let the rest run forever if you want to.
Okay.
But still have a stop area that I'll get out on the other little shares that I have that's out there,
so that you don't lose, that you still, minimize your risk, I guess you call it.
Exactly.
Okay.
Now, in your situation where you're saying, how do I know when to take all of it? Well, let's say you only have 1 contract, and I try to teach people how to trade with multiple contracts. Well, your reward should always equal your risk. So, if I got in here at 24, and I had a stop right here at 21, then guess what? I can't really bring my stop to break even until it gets to 27. Because if I'm going to risk $3, then my profit has to be $3. My reward has to always equal my risk. Because if I don't do that, then I'm not playing house. I want to be the house. The house always wins because the house puts the percentages in their favor.
Gotcha.
And that's where a lot of traders, they won't do it. they'll risk they'll let's say you had $500, they'll risk the whole $500 to make $50. And this is where you go wrong. If I risk $500 to make $50, I can win 9 times in a row and be up $450. And then on the 10th trade, I lose $500 and then be wondering where the heck did I go wrong? You were risking too much money and was taking too little profit. Whatever your risk is, your reward has to equal it or be higher.
Okay.
Equal or greater than or equal to.
So if you do 24 and you set the stop loss at 20.
Yes.
How do you, so 24, so there's $4. So my target in my mind is that it's going to go from 24 to 28 at least.
Yes.
Before I get involved in it. That's my thought process. Okay.
Yes. So when it hit 28, that's when you start making a decision. To be honest, you start making a decision at 26. Usually when it's halfway to my target, I pull my stop to break even.
Okay.
I'm not trying to lose.
Gotcha.
So you started out with it at 24 and you had a stop at 20. Then it went halfway. So 24 to 20 is $4. So half of $4 is 2. When it got to 26, you brought your stop here.
Right. So now
I ain't losing. Now I'm not losing. Then when it got to 28, you had 2 decisions to make. Okay. I actually want you to gamble when it reaches your target. Most people are not going to tell you this. I want you to gamble when it hits your target because you won. You don't know how high it's going to go. So there are a couple of ways to gamble. Do I want to gamble all of it and just let's see what this thing can do? Because think about it. The worst case scenario is that you break even. That's the worst case. Well, that's really not the worst case because if it reverses and really drops, you can really lose a lot. So what I tell people to do is sell half.
Okay.
Sell half your shares. I don't care what you do after that. You won. On to the next trade.
Right.
But the way
because the way you set your stop loss at a place where it's still above what you started.
Yeah. So you good.
You took half the profits out. Okay.
Took half the profits out. So try your best in the beginning. If you can't buy more than one share or more than one contract, try not to trade it in the beginning. I want you to think of 2 shares or 2 contracts or more on every trade.
Okay.
Because then you'll be able to manage. You're just going to be able to manage it a lot better.
Okay.
All right. And I always tell people this: the easiest way to trade is with a $25,000 or $30,000 account trading stock. There's nothing easier than trading stock because you can adjust your amount that you want to get in or out. You know what I'm saying? You can't really do that when you're working with margin on options or futures or whatever. So if you have access to it, I always tell people when you get there, it's almost like you got to the promised land. Trading becomes so easy. I can day trade $100 if I want to. Okay? I can't do that if I have an account less than 25,000 because I'm only limited to 3 trades a week.
Right.
You can have a $30,000 account and only use 1,000 of it. I always tell people that's your business. So in order for your business to maximize what it can do, it's going to cost you $30,000. I always tell people that. To have a stock business that maxes out what you can do, $30,000. That's how much a stock business costs. And with that, you'll be able to do any and everything you want to. So the goal, if you're not there yet, or if you don't have the type of capital you want to put up to do it, your goal is to try to get there.
Okay.
And then during that process, even if you have it, trade a little while, invest a little while, and then when you get comfortable and have a strategy that you use, then put the funds in to have your $30,000 account. Don't do like I did. I started out with a $50,000 account with no education. So naturally, that money got blown within the first 3 months, right? And then I had to re-up again, right? So don't make the mistakes that I made. All right. So that's Neo. All right. So let's go back to the presentation. We're gonna take a break in a second because we've been on for 2 hours. Just a 5-minute break. It's 4:25.
Okay.
Let's take a 5-minute break and be back by 4:30.
Okay.
Okay.
All right. Okay.
All right. We're gonna get into a little bit of strategy.
Okay.
Very simple strategies. I know you've probably already seen it, but we're gonna break it down. There's always that one little piece that most people miss. So we talked about the 200 day and the John Carter.
Yes.
Remember the 200 day moving average is the most used indicator on the planet. Okay, that's what every hedge fund, every pension fund manager, they know about the 200 day. So the 200 day always lets you know if a company is bullish or bearish. It's no way around it. A company that's above the 200 day has to be a bullish company. It's not if it is, it has to be, because that means that its price is higher than the last 200 days. It's a bullish company. The line is going to also tell you if the 200 day moving average is angled up, it's a very bullish company. If the line is angled down, that means that price is going down in price. I don't even care if it's above it and it's still angled down. It still tells you that the trend is down.
Yeah.
So the 200 day moving average is the one thing that everybody, like if you had to take everybody in the world and we had to agree on something, this is it. This is the middleman. This is what everybody knows about. So anything above it is bullish. Anything below it is bearish. I want to look for bullish companies that are above it with a 200-day moving average that's angled up. If it's angled down, I'm not thinking about buying it yet. Okay, until that line starts to turn around. Now, only 1% of people know about the John Carter. The John Carter is going to give you a 75% chance of getting the trend correct. Oh, why you didn't tell me my picture isn't?
Oh, okay. I'm okay.
Hold on. Let me this technology.
Mm.
Oh shoot, what did I hit? Hold on. Wrong button.
Do you have to unmute your camera or unblock your camera?
Yeah, but usually I could pull it up. Usually I could just hit a little button at the bottom and just trying to find it. It's usually down here at the bottom. Oh, I know what I gotta hit. There it is. All right, there I am. All right.
People younger than us, they get this lightning fast.
I know.
People our age, you kind of like gotta.
I'm like, here it is, right here.
Okay.
All right. So the best trending indicator on Earth, in my opinion, is the John Carter. All right. You're just looking for 3 consecutive candles. Don't make it so complicated. Just 3. If I see green, it starts over. So let's say this is green, 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 green. If I get one red candle, it starts over.
Mm-hmm.
And then I want to see 3 consecutive colors in the same direction. All right, so if I see 1, 2, 3 red candles, 75% chance that we're going to continue going in that direction. All I had to do on Apple was wait until I saw 3 candles. I could have waited for 2 or 3 months. Then as soon as I saw 1, 2, 3 candles on Apple, bam, I could have bought it that day, and we've never seen that price since March. No, since April.
Wow.
We haven't come back to that price, and all you had to do was wait for it to go 3 green. So 3 red would have got you out in February, and then you would have been right back in April. Now, using the 200-day moving average, you could have put both of them together. You could have said, all right, as soon as we hit the 200-day moving average, the 200-day moving average on your worksheet is going to always give you the discount price for that stock. That's the price that everybody is looking to buy it at. Can it go lower? Of course it can. But it's always going to be way lower than its highs. So when you saw Apple sitting at $80 a share, everybody knew at some point it was going to come down and hit the $65 range. It just so happens that the pandemic pushed it down to it. Most stocks are going to hit its 200-day moving average 1 to 2 times a year. That's the only time you're going to be able to get in. It doesn't happen that often on a bullish stock that's above it, because you're going to see price go up, go up, go up. Usually within a year, some type of negative news comes out and makes the market sell off. When the market sells off in October or sell off, during periods where markets sell off, they come down to the 200-day moving average. If the 200-day moving average is sloping up, it's a very bullish company. Everybody knew to buy it. Everybody knew to buy Apple when it hit the $64 range. And you only had 15 days to buy it before it started to go up in price.
I know all the signs.
I'm just putting some concentration on music on. Sorry.
No problem.
I can lock this in my brain.
All right, and then you have what we call that V recovery. Went down, up, V recovery. Okay. Third candle triggers the change in trend. All right. This is back in 2019. It happens all the time. John Carter went red, 1, 2, 3. You would have said, all right, maybe I want to short. Once you shorted it, as soon as it went green again, 1, 2, 3, there you are, back in it. Okay? Don't try to catch what I call a falling knife. Don't think like everybody always wants to be the person that buys it here and sells it here. You're going to spend the rest of your life trying to be that individual. Just try to make money. I want to get out when the billionaires take money out, and I want to get in when the billionaires put money in. You're not going to know when this reverses. No one can time this. Trying to do that or catch a falling knife is not the way that you are successful in this market over and over again. Every now and then, you're going to luck up and buy it at the lowest price or near the lowest price. And congratulate yourself for it. But most of your big wins, when you're up 70, 80, 300%, I promise you, you didn't buy it right here. You probably bought it somewhere around here, and it kept going up in price. And I tell people that all the time. Just because it's here, don't mean that it can't go to here. Now, if we're already here, and it's an all-time high, I can understand why you don't want to get in. But if it's got room to move, who cares if you get in at 160 or 150 if it's 5 years from now? Okay? So don't miss out on a stock because you're trying to squeeze out another $3 or $4. Okay? All right. The easiest strategy on the earth is the 200-day moving average. All right. You want to You want to look up the 30 or the 40 largest companies, Fortune 500 companies. Go on Google and literally say, what are the 40 largest companies, in the world in market cap? You take those 40 companies, those are the companies that you invest in the beginning or trade. Okay? Because that's what the billionaires are buying. They're literally looking at that same list and saying, we're not buying anything underneath this list. Or we're going to spend 80% of our funds, put it in the top of this list. Maybe we'll speculate with 20% of our funds. But they're not going to put 100% of their funds in a speculative stock. Okay? Gotcha. And you're not going to do it as well. You're going to use 90% of your funds in long-term, 10% speculation. All right? But I want you to use the 200-day, and we're going to put it all together. 200-day trend line. John Carter goes green, you get in. Okay? I don't care what company we look at, you're going to get the same situation. So for your homework, what I want you to do for the next 7 days, I want you to go get this same list. And this is your job. You're going to look at you're going to look at the top 30 companies by going to Google and saying, what are the 30 largest companies in market cap? Or you can just take this list. Mm-hmm. All right, I've done the homework for you. You're going to take that list. You're going to look up the 200-day moving average. And you're going to do the same thing. You're going to look and see when was the last time it hit the 200-day. Is it a bullish company? And look and see if it hit the 200-day and it went green on the John Carter, where you would have entered. Okay? This is a long-term strategy, meaning 30 days or longer. You're only using a day chart for this particular strategy. This is a 30-day or longer strategy. Great for options, great for stocks. Okay? And I'm going to show you how it works. So, out of those companies, I think Microsoft, Apple, actually, I think I have those 30 companies. Let me look up. I think I do. Hold on. I think I've already created that list. So we're going to look at let's see, charts of cannabis. Dang, it's not here. Oh, top 50 companies. Okay. Here's my top 50 list. Let's say I was looking at the top 50 companies and I just wanted to see what the ones that are up to date are doing. Well, I'm going to put on my day chart. My day chart is on. And I'm going to say, all right, let's look at the first 5. So Salesforce is the first one. So when I pull up Salesforce, first thing I want to look for is the 200-day moving average moving up? Yes, it's a bullish company. Great. What did it do the last time it hit the 200-day moving average? Did it respond the way that I thought it was going to respond? Well, the last time it hit the 200-day, if I had drawn a trend line, if I waited for it to go green, 1, 2, 3 green candles, how long, even if I bought it there, how many days did it take for it to go into profit? Well, on that day, it was March the 26th. It actually went lower. But then by April the 9th, which was about 2 weeks later, we were back at that price. It sat at that price, and then it rose above that around May the 6th. So even if I bought this April the 26th and I held it until May, what is that telling me? April, May. Hold up, was that April? No, that was March. March, April, May. I need at least 90 days. Well, that's what I teach. 90 days or more. I know I say 30 days or more, but 30 days or longer, 90 days or more are where you're going to make the most money. This trade would have worked.
Okay, wow.
This is the easiest trade that you're going to find. Now, I'm going to teach you how to enter your trades. This is how you enter your trades. When you see it go green, you're not going to get in right then and there. 1, 2, 3. You're not going to get in that day. You're going to wait for it to go green. You're going to wait for it to go down in price. And then as soon as it starts going up in price, this is all you're going to do. You're going to draw 2 lines. One line When you break it, it's going to go green. You're going to draw a second line. Soon as you break above that line, you're going to buy it. And you're going to go 90 days out. You're going to buy it for 147. Now check this out. In the next 7 days, it was already up 20 bucks. That's huge in the stock world and huge in the options market. You could have taken profit there, or you could have taken 90-day options and waited until it did all of this. Okay? So that's what you're going to do. You're going to go through each company and do the same thing. Amazon, same thing. Same strategy. We're going to look for two lines. Okay? We already drew the first line. We're going to draw another one right here. Are we above the 200-day moving average? Yes. Okay? You don't have to wait for it to hit the 200-day. That's just the perfect trade. The perfect trade would have been here. When it hit the 200-day, you're going to draw a trend line. You're going to connect the first three candles, and you're going to have a trend line that goes somewhere like this, something like this. It's going to hit the 200-day. You're not going to get in until you see green. Not green candles on the John Carter. Very important. If you don't have the John Carter on your chart, you're going to be reading the wrong picture. It has to have the John Carter TTM trend. You're going to see it go green.
Is that, and where is that? Is that what we're looking at the bottom of the?
No, the John Carter, you're going to go to studies, add a study, and you're going to go to John Carter studies.
Okay.
You're going to pick the TTM trend.
Gotcha.
When you pick the TTM trend, it's going to show up blue. You got to go into the properties and change the colors. You're gonna right. Get that information through my through the Thinkorswim chart setup.
Okay.
When you set up your charts, you're gonna have a day chart. Remember, the 200-day is for the day chart or longer. Don't right. Use the 200-day on a minute chart or an hour chart. We already have something for that. Okay. So we hit the 200-day. It goes green. 1, 2, 3. Joel says that's the trigger, but it doesn't mean that's when you get in.
Gotcha.
You want to see it go green, then you want to see it go down, and then start to go back up. So you're going to draw another line. You're going to draw a line maybe right here. It's going to drop in price. You're going to wait for the first day that it starts to go up, and then that's when you're going to buy it. For $1,962, 90 days or longer. Okay? I mean, it started to go up immediately. It never came back. Never. And now it looks like it wants to drop, but the 200-day is so low. Can we get the stock to drop down to 2602? Maybe. Okay? If we wake up, if the earnings comes out, you see that earnings right there? We have an earnings date on the 29th. Now, Amazon, Apple, and Google are all of their earnings reports are going to be on the same day, on Thursday this week.
Oh, wow.
If this stock mess around and has a bad earnings and pops down to 2603, you're going to see a lot of people buying it. Now, it would have to drop $700. Which is almost a 25% drop. Can it happen? Yeah, it can drop 20%. Okay? But it has a upward sloping 200. Let's look for a company that doesn't have an upward sloping 200, which is why you shouldn't be buying it, like an American Airlines. Check this out. Downward sloping 200. Why aren't people buying it? Because hedge funds hate to see this. It's a 45-degree angle going in the opposite direction. It's sliding. Wow. Maybe as an investment, but not as a trade or and as you can see, we're about to break. We just broke this trend line and we're about to go even lower. You see that?
Wow.
Which is why I've been telling people, why are you buying this? Look at what happened the very first time it hit the 200-day. What did it do? reversed. Because when you have a downward sloping 200, it does the opposite of what a company does that's bullish. A bearish company is going to hit the 200-day and reverse. You see that?
Mm-hmm.
I mean, it almost did it to the penny right here.
Wow. It's now it's a resistance level.
Now it's a resistance area. If we get above it, you can take a shot. Just have a tight stop. Okay? Because it has been going up. It hasn't been going lower than this low. So it's trending up, but this 200-day needs to turn around. And everybody's just waiting for the economy to open back up. So you could be taking a shot on this as an investment, but as a trade, nah. You want to trade one of these top 50 companies as a trade. Let's look at you pick
one. Let's see. NVDA.
All right.
NVIDIA.
Yep. So, do we have an upward sloping 200? Yes. It's holding its trend line. See that? Holding its trend line. Holding it. It is going red. So, when I see stuff going red like that, I hold off. I'm not about to buy this company. Looks like it wants to go down in value. It doesn't mean it's going to zero. It just means I can wait until it starts to pop up. It pops up when money starts to flow back into it. Money's coming out of it right now. I don't want to buy something that money's coming out of because I don't know how long that money's going to come out of it, because when billionaires take their money out of something, they don't just do it in one day. It might take a couple of days, a couple of weeks for it to happen. And then when they all get together and say, all right, we're about to buy NVIDIA again, then I'll be there to buy it. It's still a bullish company because it has a upward sloping 200. The last time it hit the 200-day moving average, because you always want to see if the stock that you're looking at performs the way it's supposed to when it hits the 200-day. Well, check this out. We want to see a trend line. We want to see it hit the 200-day. We want to see it go up. We want to see it go green. 1, 2, 3. We want to see it go down and then back up.
Wow.
1, 2, 3 green. Does it go back down? Yes. Does it go back up? Yes. How long were you down? 3 days, and then it never came back.
Wow.
Okay. That's what companies do when they hit their 200-day moving average. Why? Because it's the best risk to reward ratio you're going to get on a stock ever, is the 200-day moving average, which is why I tell people it's the easiest strategy. Nobody has ever shown me an easier strategy than this on the planet. This is the easiest strategy on the planet. Okay? I incorporate the John Carter to give you an even better chance of winning. That's what I've added to it. Some people don't have none of that. They use the basics. They say, look, hit the 200-day, broke it, closed about 2 days, bam, it's gonna go up in value. Some people say, bump it, I can wait. They'll just buy it when it hits the 200-day, and then they'll say, I'll just wait 3 days and then I'll buy it. Okay, and then yeah, because it don't matter. All of this was right. All of this was right because it's higher now. Okay.
And it seems like a very consistent pattern with all these stocks. Except for the industries that are tanking right now.
Right, which are not going to be, usually the industries that are tanking are not going to be, well, I'm not going to say they're not one of your 50 largest companies, but because they've been falling and other companies have been surpassing them in size, they're probably not part of the 50 largest companies because they ended up falling and then the other companies surpassed them. Because that list changes. That list changes. So you look at a Walmart, same thing. It's like a broken record. The last time we hit the 200-day, draw a trend line there. Last time we hit the 200-day, You could have bought it that day. You could have just bought it for 118 and said, Joel, I ain't got time for this trend line and all that. I'm just buying it. It's a 2, 3, 4 year trade. I see people do that all the time because I'm just trying to squeeze out so during this time you could be making money somewhere else. If you got 2 or 3 years, who cares about this breaking the trend line and going up? Just buy it when it hits the 200 day. It hit the 200 day at 119. It broke it. It went green, 1, 2, 3. We don't get in just because it's green. We want it to go down, then back up. You would have bought it sometime during this day for 121 up to 126. Didn't matter even if you bought it at the highs because we're sitting at 142 right now. And that was the last time it hit the 200 day. What is it doing now? It's holding this pattern. If it breaks here, it could come to here. Why did I pick this value? Because anytime you see something go down and then back up and it forms that V, the bottom of that V is a support area. So that's a support area. This V, this is a support area. This is a V, this is a support area. Those are minor supports though. They're like nets. Think of them like net. If you were a trapeze artist and you fell, they're going to be areas of support. Mm-hmm. Bam, bam, bam. And then you got the 200 day that acts as a support area. Am I going to buy it now? No, I'm going to hold off because it's a little red right now. But if I wanted to, I could have bought it when it hit there. Mm-hmm. If I think it's not going to come back. To be honest, I love Walmart. So let me set an alert here. I'm going to set a couple of alerts while we're here. Set an alert there, and then if we break down to here, 135, I started buying it again right around 118. Okay. And see, I have an alert here. When the 200 day was a little bit lower, I actually need to raise this a little bit. But that's Walmart. Okay. So that's what you're going to look for. Your homework is going to be to go to the top 30 companies and learn how to draw your support, resistance, and trend lines. Okay. All right. Last thing we're going to talk about is we're going to talk about intraday trading and swing trading and when to do it. I tell people all the time, 1 to 30 days is the hardest time to trade. Mm-hmm. Because if I was day trading, I can control the movement of the stock. Even if negative news comes out, I can get in and out of that stock that day. Uh-huh. 30 days or longer, I can stomach a CEO getting a DUI. And then all of a sudden the stock starts to fall in price. And then they go to rehab, and then the stock starts to go back up. Uh-huh. So I can stomach negative news when I go 30 days or longer for a bullish stock. But if I'm trading 1 to 30 days and anything negative happens, chances are I'm not going to be able to recover. Because if I'm holding it overnight and I get some negative news, it takes about 2 to 3 weeks for the news to turn around and people start to buy the stock again. That's why 1 to 30 day trading is the hardest trading to do. And that's where 90% of my clients try to trade. Because they're too impatient to wait 30 days or longer. I need to see money now, Joe. I got a bill I got to pay next week. But then they got a 9 to 5, so they can't day trade. So what do? Well, I can buy this and then sell it tomorrow, or I can go to work and then on my lunch break, see what's up, buy it, and then go to work. And then tomorrow when I wake up, I can see how that stock is doing. Well, that's also the laziest way to trade. The laziest way to trade is 1 to 30 days. It takes discipline to day trade. It takes discipline to trade longer than 30 days, which is why so many people lose in the market. Okay? I want you to do all three if you can. Okay? Uh-huh. So let's break down the charts. The 1 minute chart is going to be your scalping. I don't ever want you to trade on the 1 minute chart and be losing and hold it overnight. You
Mhm.
can day trade all you want to. You can trade all you want to be up $2,000 and be like, you know what, Joel, I'm gonna hold one contract overnight. I already took my profit. I just want to see what happens. You can gamble when you're profiting. I do not want you to gamble when you're losing.
Right.
And that's what a lot of people do.
Oh, right.
Your 1 hour chart is going to be your swing trades. You can see my screen, correct?
Yes, I can.
All right. Your 1 hour chart is going to be the 1 to 30 day trade. So if you just got to trade 1 to 30 days, I don't want you to use a 1 minute chart. I don't want you to use a day chart. I want you to use an hour chart. It's going to give you the best chance of winning, in my opinion. And then you're going to look at a day chart. I don't want you to mix these charts. I don't want you to take this day chart to try to take a 1 minute chart trade, because what happens in the hour that you're trading has nothing to do with what it's been doing for the last couple of days. It just doesn't. You can have a terrible stock that's just up for the day. And if you're trading it and it's on the percent gainers list and the billionaires are buying it, it's going to be the call of the day. So by looking at this chart and this chart, it's going to throw you off. So many people use multiple time frames to try to trade. I don't know how they do it. All right. But you can do it. I just don't understand why they're doing it. They're just confusing themselves. A day chart is going to be a chart that's 30 days or longer, swing trading or long-term trading. All right. So we're going to use a new tool. It's called a new study called the Ichimoku. The Ichimoku is basically like the 200-day moving average. It's literally the same thing. It's just the 200-day moving average for lower time frames. So I'm going to use a 1 minute chart or a 1 hour chart when I'm using the Ichimoku.
Gotcha.
The Ichimoku is this cloud. Looks like a gaseous cloud. You're going to see a cloud that's green and red. When you're above the cloud, I want you to think of it like a plane. If you're flying a plane and you get above the clouds, you're in clear air. Okay? You get now, the pilot tells you can take your seatbelt off and you can walk around. So if you're above the cloud, you can be bullish. When you're below the cloud, it's bearish. It's very easy. That's literally how you trade it. So if I was day trading, I want to look for a company that's above the cloud that's got green candles. And I'm going to go to the upside. And I'm going to use the same 3 moves. I want to see something pop, flop, then start to go up again. When it starts to go up, that's when Joel gets in. And my stop's going to be right there. So 1, 2, 3. 1, 2, Joel gets in. 1, 2, Joel gets in. Joel's stop is right there. If it goes up, down, I get in, and then it turns around. Oh, I'm out right there.
Gotcha.
When I win this much. When I lose, I only lose this much. Okay? You're going to use this same setup for your hour trades or your hour chart trades, which are 1 day to 30 days, and your 1 minute chart. Okay? So the cloud, the way the cloud works is, I see that it's red, but red is like a cautionary state. It doesn't necessarily have to be green for you to be long. But if it is green and it's green over here, it's a better chance that you have for it to go to the upside. Soon as it breaks below here, I want to short. People always ask, well, what do you do when it's in the cloud? I don't know. What would a pilot do when he's in the cloud? Can't see. Or she or he can't see. So I don't know what they are going to do. I want it to be above it or below it. It's gambling if you're in it. Okay? I want you to use my method of entry. So what is my method of entry? My method of entry is the 3rd wave. 1 move up. Rookies get in at the top. 2 moves down. 3, the 3rd wave is going up. I want this on sale off of the first move. See, we all get the first move, right? It's just the rookies going to get in right there, and then when it's sell, they're going to sell. When it goes down, they're going to sell it.
Okay.
I want it to pop, flop, but I don't want it to flop so much that it goes back to the bottom. I want it to flop about 50%, Because stocks that trend up are only going to drop 50% and then keep going higher, and they're just going to stair step like this.
And that's right there is a Fibonacci 50% level, more or less.
Yep, exactly. So I want to see it go up, flop, then go right back up. Joel gets in. Stop is going to be right there. I guess we were getting to it. The trend is your friend. You want to get in on third wave entries, your stop's going to be here. 1, 2, 3, Joel stop. 1, 2, 3, Joel stop. If it was going down, it would go down, up, down. Joel stop would be at the top. It's always at the top or the bottom of the second move. Okay?
Uh-huh.
All right, so let's do a review. All right, before we go back to charts and I start showing you exactly how to do it on a 1 minute and a day chart. You want to separate your accounts. All right, you want to figure out if you're trading or investing. If you're trading, you're going to be using a 1 minute chart or a 1 hour chart. You can still trade using a 30-day using a day chart. You're just going to trade up to 12 months. Okay. If you're investing, there's no other chart you need to look at but the day chart. You want to use the beta and the VIX to determine your conditions. You know, am I trading a stock that can move, or am I trading a boring stock that don't move that much? That's gonna be the difference in how much money I can make, whether I'm trading or I'm investing. I also want to look at the volatility index to see what the conditions of the market are. I want to use the what would Joe do method for entries and exits. You got to make sure that you're looking at the correct time frame. I stress that a lot. You got to know if you're looking at the 1 minute, the 1 hour, or the day chart. You want to find the stock setups through the John Carter TTM trend. I'm looking for them 3 candles. I also want you to use your Fibonacci tool. It's not necessary, but I want you to use it. I only want you to use the 200-day moving average for 30-day or longer trades, preferably 90 days. I only want you to use the Ichimoku for 30 days or less. Don't use the Ichimoku for longer time frames. You got the 200-day for that. Okay? All right, so let's go look at the charts. Any questions so far?
So far, so good.
All right, cool. So let's say we wanted to day trade again. Let's use the Ichimoku. I have a day trading chart. So what do I look for? We're going to go through this process again. When I'm looking for a day trade, I don't know what I'm going to trade that morning. So I have 2 options. I go to my public percentage gainers list, and I go with a list that that Thinkorswim already created. Now, I have
that percent gainers or percent losers, that is done by Thinkorswim?
Yes.
Okay.
But I add my own the criteria of, or I customize what I want on it. So when you pull up your watch list, you can go here to create your watch list. When you create your watch list, you're going to go over here, and all of this stuff that I'm showing you is in that Thinkorswim chart setup video that I'm going to give you.
Okay.
You're going to go to here where it says customize, and then you're going to customize what you want to look for. I want to look at the percent change, meaning I want to know how much that stock is up or down for the day. I want to look at how big the company is by looking at the market cap. I want to look at the net change, meaning I want to see the dollar amount that it changes. I want to see the last price, of course. I want to see the beta. Is this a stock that normally moves, or is it just moving today? And then I want to use what I don't really talk about that much in the room, which is the ATR. The ATR is the average true range. Okay? Now I'm going to use the default settings for that. The default settings is 14, and a guy named Wilder is the one that found it. And what it's doing is it's looking at the last 14 days of this stock, and it's going to give me the average move in the last 14 days from the lowest to the highest point of that day, and it's going to give me the average of that every single day. So if it moved $12 one day, $14 another day, $13 another day, the average is going to be 13. Well, that gives me an idea how much something can move. So if I'm trading something and I look at the percent gainers list and I see it's already up $12 and the average is 13, maybe I'm approaching, an area where it's maxing out its move. Now, I usually go about double. When it shows up on the percent gainers list, I usually go with a stock double whatever the ATR is. So if I see a company that's up $2, I'll trade it until maybe it's up $4. I also want to look for what I also look for is I want to look for companies, like right now, this is like a penny stock. So the company is really small. That's why it moves so much. So I always go to my market cap and I always look for the largest companies. Because I don't really want to trade anything that's $1 billion or less. I'll go down as low as 500 million, but I don't teach that. So I'm going to just say stop at $1 billion. So now when I look at a company and I look at its, if I notice it pop up on the percent gainers list and I see the average true range is 162, I double it. So I say right around $3.20, I'm probably going to start trying to get out of it. Well, sure enough, it was up, what, $4, about double what that is. This was $7, okay? Well, this actually was only 9, so it was near the average true range, but it's at least going to get to, this is double. This is almost double, okay? This is like triple, okay? But you see how they're all about double or higher? 4, 8, 4, 10, 75, 125, 3, 4, $2. You see what I'm saying? $3. $2, 6. When I'm trading it, I want to see about how high it can go. So let's say I was looking at the percent gainers list and it's like 9:30 in the morning. I want to look for, like I said, I want to look for the largest companies. I want to look for something that's up more than 2%. So let's say I wanted to trade hogs because I saw that it was up 22%. I'm going to click on it and I'm going to say to myself one or two things. Is hog above the Ichimoku or below the Ichimoku? If it's above the Ichimoku, I want to go long. If it's below the Ichimoku, I'm not going to trade it because I don't trade good companies. So I'm going to look at my day trading chart.
You said you don't trade good companies?
I don't short good companies.
Oh, okay, great. Yeah, okay, thank you.
Okay?
Yeah.
So let's say you wanted to trade hog. Joel says he trades on the third wave and he wants to make sure it's above the Ichimoku. Well, at 9:30, this is the Ichimoku. Are we above the Ichimoku?
Yes.
That means you can trade it. Are you going to trade it just because it's 9:30?
No.
No. I want to see a move that goes up. Then I want to see a move that goes down.
Wow.
Then I want to see a move that goes up. So if I wanted to trade hog this morning, I would have said, this is the first move. This is the second move. This is the third move. Joel would have been in right around $33.50. So if you want to know how I trade, I would have taken $20,000. Now, I'm going to teach this later. I usually stay in trades for about an hour. I'm going to trade this from about 9:40. 9:40 is when I love to get into trade. Everybody knows that 9:40 to 9:45 is my sweet spot. If I see something breaking at 9:40, I'm taking it almost 100% of the time. Because that's my number. So I see it breaking at 9:40. I just start smiling. Ha, this is about to make me some money. I buy this at $33.50. And within an hour, let's say I was in this trade from 9:40 to 10:40. I could have 9:40 to 10:40 was right around here. We rose all the way to 30. Let's just say $37. You want to see how much money I would have made? I would have been up $2,000. Okay. What I'm showing you right now is my setup for options. The reason why I'm using the number of 20,000 is because you can make that same amount of money using about $1,000. Sorry about that. My dog is acting a fool. So I always use this amount of money to let people know with $1,000 or $2,000 trading options, which is what we're going to learn next session. Same exact setup. So we're going to go over the same exact things that I'm showing you right now. Okay. But you're going to trade the options. Okay. But I want to show you what to look for first because most people don't know how to do it. Now earlier, let's see what it did. So as you can see, it went up in price. Now, everybody's going to always ask, well, how do I know when to get out? Well, first of all, let's figure out where our stops are. This was the first move. This was the second move. This was the third move. I got in at 33.50. That means if I got in at 33.50 and my stop was, let's just say, it doesn't always have to be exact, but let's just say 32.50 or 32. Let's just say 32.50. If I got in at 33.50 and my stop is 32.50, that means when it got to 34.50, that's when I bring my stop to break even. Okay? Because I was up $1. I was risking $1 to make $1 or more. So I could have when it got to 34.50 sold. I don't know how many shares I had. I think it was 500 or something. I could have sold 250 shares, let the other 250 run to 4 o'clock if I wanted to, or to the next day if I wanted to. But I knew to bring my stop to break even when this was about 50 cents in my favor. Soon as it was up about 50 cents, because I was looking for $1 move, you had two options. You could have said, I'm taking all my profit right there at $34. Or I'm sorry, at $34.50. You could have taken all your profit at $34.50 if you wanted to. And I don't mind you doing that because as long as your reward is equal to or greater than your risk, you can take your profit. Or you can gamble a little bit and say, hey, I've been up 3-4 days this week. I'm going to sell half and let this bad boy run.
Okay.
So that's how I would have approached it. And then people would have said, well, Joel, when should you have gotten out? Well, there's a couple of options. Some people get out if they see 3 red candles.
Okay.
Some people get out when, as long as you're in profit, some people get out when this trend breaks and then it gets 3 candles.
Gotcha.
Some people get out, they don't get out until they break this Ichimoku to the downside and go 3 red candles.
Oh, wow.
Because when that happens, people started to short. Gotcha. Some people would have got out here and would have started shorting. You could have said, let's say we were shorting and this went here, 1 move, 2 moves, 3. You could have started shorting, 1 moves, 2 moves, 3. You could have started shorting here if you wanted to. And because you are already up in profit, you don't necessarily have to put your stop right there. You could put your stop a little bit higher if you wanted to. And some people would have said, I'm going to make money to the upside and I'm going to make money to the downside. You see that? How did I know to make money to the downside? Because we underneath the Ichimoku now.
Right.
Underneath the Ichimoku means go down. And it's angled down. Okay? And then, once it broke back up, maybe they got out. People that wanted to go long. I'm not going to get long, even though this broke above the Ichimoku because this is angled down. I'm not going to go long.
Gotcha.
I'm not going to go long until this flattens out
Okay.
or goes up.
Okay.
So if I got in long on this, it would have been somewhere around here. But I would have lost. Why? Because you're taking a shot on something that had been selling off all day. But even if I had gotten in right around here, I only lost this much. I risked even less on this trade. I only risked 30 cents. You see that? Because I would have got in here and I would have had a stop right there.
Oh, okay.
I didn't even risk $1 like I did earlier. I risked 30 cents. Okay? So you could take a shot even after you won. And I'm not going to take a trade at 315. Now, the market is its most volatile from 9:30 to 11 o'clock, and then again from 2 o'clock to 4 o'clock. Okay?
Uh-huh.
So like 9:30 to 11 o'clock, which is an hour and a half, and then again from 2 o'clock to 4 o'clock. So those are the different. I don't trade in between those hours. I don't even trade 2 to 4 o'clock unless I'm bored and I don't have nothing to do, or I'm up real big for the day. I might take a shot at 2 o'clock, between 2 and 4 o'clock. And see, I could have made money on this move right here at 2 o'clock. You see that? You remember how I just told you 2 o'clock to 4 o'clock?
Mm-hmm.
Look at what happened if you had gotten. I could have gone short right there at 36.3, and I could have caught a whole nother $1.
But you said you said
I don't short. Yeah, I don't short. Yeah, I don't short.
Okay.
I just don't. But it's up to you to decide how you want to actually trade. Okay.
Okay. And what do you think about paper trading?
I think you should do it. Like paper trading, even if you have an account, paper trading is always the best place to test things out before you put it into real play.
Okay.
And that's actually where I would rather you be before you go. Now, if you're going to paper trade, a couple of things you want to make sure you have. I don't know if you said you had a TD Ameritrade account. I don't know if it's funded yet or not.
I mean, I can move some funds, or I can move some funds over because I have a lot in my checking. Like you said, you only keep $100.
$100. Yeah.
And that's a big jump off the big high dive. You know what I'm saying? To take it out of that, and really just get my mind around. Okay, this is, you always think about the FDIC. This is guaranteed. This is guaranteed. So
yes.
I haven't been able to move in that headspace where I just say, okay, look, as long as I'm babysitting this in the most conservative areas, you said the long term, as long as I'm babysitting that, I'm fine.
Yeah, you're watching it, so you're gonna be fine.
Right. So I need to jump. That's what but I'm nowhere near 20, so.
It's fun. You can get there fast through options and futures and whatever else you have. You can get there quickly. Just got to know what to look for. But like even with this one, like you see TCEHY was up.
Okay, I don't see your
screen again.
Yeah.
That's interesting. It goes away sometimes and then it pops back up. Let's try it again.
Oh, there we go.
Can you see it now?
Yeah.
Right,
I thought it was on my end, but it's okay.
Yep.
Okay.
Yep. All right. So let's say we were looking at Tencent Holding. This is a Chinese company. All right. Same thing. It's gonna be the same. And what I teach is the same setup. You're gonna start seeing things the same way I see it. So remember, 9:40 is my sweet period. So if I see a stock pop up like this, and then I see it go down, and then I start seeing it go up at 9:43, I'm buying it.
Okay.
All right.
Okay.
And that's the period. Like, don't send me a text. Don't even try to talk to me during that time. Everybody know at 9:40, Joel is trading.
Okay.
Okay. I didn't know that I was going to trade this that morning. Okay. So you want to start compiling a list. So you're going to be able to get this. You're going to be able to see this list. So I'm going to pull it up so you can see it. So my StockStar list, I create a list for myself of companies that I really like trading. And when I see my list pop up, I literally will trade only what I see on my list. And if I see my list pop up and I see a company up more than 2%, I'm trading it. Okay. So if I was to see, Snow was one that everyone was looking at this morning. So Snow popped up. Let's see if it did what it was supposed to do. Sometimes stocks are just going to get away from you. Sometimes that 940 comes and it just keeps going up higher and higher. Just got to find another stock. But look, even here, look at what happens. The stock pops in price. This was the first time it went down and went up. I would have missed it. I would have been mad. Then it got here. It went down. Then it started to go up right at 945.
Wow. Okay. So where it goes down and goes up, it doesn't necessarily have to have red candles. It's really literally can have same color green candles, but just the bulls are or the bears are overcoming a little bit, and then the bulls rush in. Okay,
but there's so much buying pressure because it pops so high. People that were short the night before, they got to cover. So you're short squeezing them. And you just want to see this move every morning. Every morning, this is what I'm looking for. A stock that's up big, that's gonna short squeeze the overcome the bears, and you're gonna see the same move, same pattern not every single time, but most of the time. And when you're wrong, you're gonna be wrong fast. And then you go on to the next one. Now this morning, I'm gonna show you what I was trading. And it's funny because I've been getting caught. Like some mornings I'll go stock futures. And it looks like the market will go up future stock. So I've been picking wrong every single morning. So I've been kind of frustrated. So I was trading the NASDAQ this morning. So I was looking up the NASDAQ and I was looking for the same move. And this is the futures market. I'm getting a lag now. Hold on. What's going on here? And I got this craziness this morning.
Oh, geez.
Look at what happened from 9:30 to 10:30. I got this sideways craziness. So when I got in, I gambled a little bit, and I started to go long right here, right at 9:42. Well, as you can see, I was only up for about 3 minutes, and then it came back. All right. And then it went lower, and then I had to get out and break even. Then, did I go short here? Oh, nah. But then it just went sideways all the way up until about 10:15. By 10:15, if I'm not in a trade, I just don't trade it. All right. But if I had stayed with it, I could have waited for this move, one move up. I see it go up here too, but you're underneath this, so I don't count that. I want to be above it. So I would have saw one move up. I could have been patient and waited for this one move up, one move down. I could have got in right there, and I could have made a quick little profit right there. But we're approaching like 11 o'clock right here. And because the Ichimoku is still up, guess what happened? It stayed going up in value until it broke beneath it. So the NASDAQ really didn't do too well today as far as a move that went directly in one way and then, to the other way. So, every now and then you're not going to see it happen. But the worst case scenario was I broke even. Like, when I get mad, it's because I break even. If I was looking at Peloton, because I want to make sure you understand how this thing works. Let's look at Peloton.
Okay.
Peloton at 9:30. It went up. It went down. Now this is what got me. At 9:35, it started to push. So then I probably would have missed this move. I probably would have been in this move. at 9.42, I would have caught $1. Now $1 is okay because look, if I get in here and I'm risking 121, that means at 120, I was going to be risking $1. So when it popped $1, I would have put my stop at break even, and then I would have broke even. Okay, so this would have been a trade that I didn't make any money on, but at least I broke even. Right. You see how my terrible trades are still break even?
Yes.
That's where you want to, when you become a really, really good traders, that's how you want to trade, where you're breaking even is your worst trades. And then I wait. And like I said, this is why I don't short terrible companies, because once it got beneath here, somebody probably would have tried to short it here, and they would have got their heads taken off.
Gotcha. Well, wait a minute. You said you don't short terrible companies, or you don't short?
No, I don't short good companies.
Good companies, okay.
I will short terrible companies.
Gotcha.
So if I'm gonna short, something like an airline company or a Carnival Cruise or
okay.
And guess what? And you can do that. You can go to your public list. You can go to percent losers list, and you can do the opposite. And you can say, all right, what are the biggest companies out there that are terrible? I'll look for something that I know is terrible, like Lyft has been terrible lately.
Oh yeah.
But I'm literally looking for, like, when I see the airlines or the cruise lines on this list, I'm shorting.
Okay.
But same thing. You can do the opposite. So let's say you wanted to short Eli Lilly. Well, I'm gonna do the opposite. I'm gonna wait for it to pop down in price and then pop up and then back down. So I want to look for a move that goes down and then up, and then I'm going to start shorting it around 134. So this would have been, so on a short, this is the move down, this is the move up, this is the move back down. I'm going to short somewhere around, anything lower than 135.31, and that's where my stop will be. My stop would have been right there. I don't even think. Now look, we never hit that, so I could have shorted this morning and done the same thing. What was your question?
Okay. One time I was watching you in the trading room, and you mentioned. So either it's going to be a up or down, and then up, and then down again, and somehow you coordinated the third line to know how long it was going to go down by looking at the first line, or maybe the angle. I'm not sure. Maybe I may have.
Well, usually the first move, and this is a big move, so it would have to be during here. Usually the first move and the third move. Usually the third move is longer than the first move.
Right, so that's what you're saying.
But because there was such a big gap, you're not going to get it here. You'll see that type of move when you're looking at an hour chart.
Gotcha.
So let's say I was looking at an hour chart for Eli Lilly. Well, and then I was going 1, 2, and 3. Well, this would be the first move. This would be the first move. This would be the second move. That means the third move should be as long as that one. So the third move should have been at least that long.
Okay.
First move, second move, third move should equal the first move, which it actually did.
Okay, right. Okay.
That makes sense?
Yeah, took some time to
Yeah, it took some time, and then it tried to fool you. Popped up. Anybody that had a stop right there, look at what it did. It just played with them and took out those stops because they knew people had a stop right there.
Okay, so now, and then when I see the John Carter here with the, well, this is going down, so I'm not sure if that's applicable, but I see 1, 2, 3, and so that kind of, you said when you see 3 candles, that just is a 75% indication that the trend is going to go in a different direction or go into sideways. Okay.
Yes, but because you're underneath the Ichimoku, I don't want you to look at green anymore. It's only red. When you're above the Ichimoku, it's only green. It's all about the green or all about the red. So once we once we pop below the Ichimoku, all I'm looking for is red candles. 1, 2, 3. I got 3 red there. When it popped the green, I would have held off, and I would have said, ooh, 1, 2, 3. There we go again. But I'm gonna wait for it to go down, up, then I'm gonna get in. And I saw green again. I saw 1, 2, 3. I'm gonna wait for it to go down, up, then down again. I would have been short right around 142. I would have caught this whole move.
Oh wow. Okay.
Even here, it went red. Look, it went green. It doesn't matter because it's underneath the Ichimoku that's angled down. 1, 2, 3. It goes down, up. Joel gets in, but I mean, shoot, you would have gotten in late on this one and still made some money.
Okay.
Still made $2, and you got in on the day that it broke to the low. So if you want to short on a day that the market is down, switch to your percent gainers list. All right. And last thing that I want to show you is you can find out how the market is doing as a whole by going to your market watch. Market watch is also going to give you an idea if the market is heavily on the bull side or heavily weighted on the short side. Okay. So looking at this, it was 50-50. And that's why the market wasn't up that big. The market wasn't up today. The market literally was like up, I think, maybe 1/3 of a percent. Well, the Dow was down 0.8%. So when you see red and green, I don't know. But if I look up, if at 9:30, I look at this heat map, and the way that you get the heat map is you go to Market Watch, you go to Visualize,
right? Yeah.
Then you go to Heat Map, and I look up and you say you know about this?
I've seen this on FinViz. I was looking at it there, so. And
I see, and I mean, if I see it heavily green and like no red, I'm buying tech stocks.
Okay.
For a day trade. Don't do this for something that you're holding overnight. Remember, what you see for the day is for the day. Anything can change overnight.
Right.
So I want you to do all 3, but I want you to understand that the easiest way to trade is 90 days or longer. The second easiest way to trade is day trading, which in some people's opinion is the easiest way to trade if you have everything in place.
Right.
And then 1 to 30 days is the hardest way to trade. It can be done. You just got to make sure you use an hour chart and you're real tight with your stop losses. You got to get out when you're supposed to get out, or you're going to lose a lot of money.
Okay.
All right, and I think that's it for today. Let me go back to the let's make sure we covered everything. Yep, covered everything. So next things is trading options. Okay. So what I want you to do is I'm going to give you a code. I'm going to send the code to you. What I want you to do for homework. Where is it? Oh, what I want you to do for your